why it turned out to be for you a very good deal.
I stumbled on the public real estate markets where there were companies that owned real estate that were trading well below where these buildings traded out individually. And then we said there's this new commercial mortgage-backed securities debt, which is much lower cost than leveraged loans and high yield that you typically use in a buyout. And we convinced the banks to let us use that to go buy real estate companies. And beginning in late 03 through 07, I think we did 12 of these deals where we started buying these big public real estate companies. We used the public CMBS debt. And then in many cases, we would sell off pieces. Think about it as a fruit basket. You'd sell the grapes to the people who wanted that and the bananas over here. And that's what equity office was all about. We bought the biggest collection of office buildings in the United States. And so it was like running a store where on the front end you're taking in the merchandise and the back end you're selling it. And so within 60 days, we ultimately won the auction. We sold almost 2/3 of the real estate. We paid down our debt. And we ended up owning really great real estate. One thing people don't focus on is we kept assets in California and New York and Boston. Had we kept suburban Chicago and Stamford, Connecticut, it would not have been so good. So at the end of the day, it was a wholesale to retail arbitrage, but the key was what we kept, and then we held it and ultimately tripled investor capital.
In the end, it turned out to be a great deal for you.
Yes.
Right? The people you sold the real estate to, it wasn't so good for them because the real estate market collapsed more or less when you completed the deal. So ultimately, did you ever buy some of that stuff back from the people you sold it to before?
We ended up buying some of it back, and a lot of those people are my friends. No one knew at the time the music was going to stop.
So let's talk about another deal you did that also turned out to be probably the most profitable buyout of all time. It's real estate related. Right before the market crashed in 07, 08, you bought the entire Hilton Hotel company. What was your thinking about buying Hilton Hotel? Was it a real estate play or a corporate play?
I'd say it was a bit of both. We did the transaction with our real estate private equity funds and our corporate private equity fund because Hilton owned great real estate like the Waldorf Astoria, the Hilton Hawaiian Village, but it also had this amazing management franchise business. And when we bought the company, it was similar to the equity office transaction in that we thought we were able to buy something because of the scale and because it was in the public markets more inexpensively than we could buying these assets individually. And we also believed that the multiple was reasonable. We were paying 13 or 14 times cash flow for what we thought was a great business. Our mistake, of course, was that our timing was terrible. We closed on the transaction at the end of 07. In less than a year, of course, Lehman would collapse, the global economy would be melting down, global travel would decline dramatically, this company's revenues would go down 20%, cash flow would go down 40%, and we marked our largest investment ever as a firm down by 71%. That was not a good feeling. But what I would tell you is we believe the decline was cyclical in nature. And so we invested $800 million more at the bottom. We stuck with the company. It started growing. There was a cyclical recovery. We ultimately took it public. We broke it into 3 different companies, a management franchise, timeshare, and real estate business. And we made $14 billion for our investors. So it ended well.
Well, when it wasn't looking so good, did you go home to your wife and say, you told me to go into real estate and maybe it wasn't such a good thing? You didn't say that?
You know, it's funny. In all seriousness, my wife and my children, that was really important. As you know, in a period of time when things are stressed, having people you can rely on and talk to and who still believe in you is really important. And it was hard because you felt terrible, you felt badly with your colleagues, with your investors, but we never lost faith. And really for me, that experience, that searing experience in Hilton was probably the most important thing for me as an investor, because what I learned was we bought at the worst time possible, and we ended up having the most successful deal of all time. And what that said is we had bought a really great business in what we call a great neighborhood. It had terrific tailwinds. People, global travel is a growth industry. These brands were super valuable. And so what it's led me to think is, too often when we invest capital, we focus on, I'll call it the individual house, not am I in the right sector? Do I have those tailwinds? And in this case, this was a fundamentally great business, and we could afford to have paid too much and do it at the wrong time. But ultimately, with the right management team, the right financial support, we made a bunch of money. And that has really impacted everything I've done since then. I think this shortage in housing will become more acute. And so we continue to like it as a sector to invest in.
Deutsche Bank ready to pay more and pay out more in terms of bonuses for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
Call it the incredible shrinking office building. As more Americans work from home, demand for office space is plunging. The result? Big investors are putting their money into warehouses, data centers, and studios and other production spaces used for streaming. In January, Blackstone took a majority stake in dozens of warehouses, most of them in California and Seattle. The rise of online shopping has made warehouses and other logistics properties more valuable. Last month, Blackstone bought data center operator QTS Realty Trust for roughly $10 billion. The numbers tell the story. Office space in the U.S. made up 19% of Blackstone's portfolio in 2015. Now it's 4%. Hotels were 23% of the firm's portfolio in 2015. Now 6%. But logistics properties have surged from 9% in 2017 to 38% now. Let's talk about two different types of real estate. There's residential and there's commercial. So is residential less risky or more risky than commercial?
Well, if you talk about for-sale single-family housing, there's probably more risk in the sense that you're building something and you're selling it and it's a function of the market. If you're talking about rental housing, think about an apartment complex, that tends to be less risky because it's less cyclical. People don't give up their apartments when there's some volatility, but nothing like, say, office buildings or hotels. So I would say residential rental real estate safer, less volatile. And then commercial real estate involves office buildings, warehouses, which has been the biggest theme for us over the last 10 years, hotels, shopping centers, senior living facilities, and all of them have different risk returns depending on geography.
Another way of looking at real estate are things that are already existing and things to be built. So is it riskier and higher reward to build something, or are you more in the category of trying to buy things that already exist?
We generally are in the business of trying to buy existing real estate at a discount. So we bought the Cosmopolitan Hotel and Casino in Las Vegas, and we bought it for less than half of what it had been built for because it was built during the financial crisis. So that to me is ideal. Occasionally we'll build things, but in general we like to try to get into real estate at a lower basis when it's already producing income. The problem with development is it's a bit like saying I'm going to IPO 3 years from now. When you show up to lease up your building, we could be in a different economic environment, and therefore you may not have tenants, you may not have revenue. So we've generally biased towards existing real estate.
Now, as a general rule of thumb, over the last 100, 200, 1,000 years, real estate prices generally go up, values increase generally. But why is it that sometimes real estate developers, you read about them going bankrupt? Is it because of leverage or because the values actually went down?
I'd say that the classic sin in real estate is you have long duration assets and people finance them short term. And so for developers who often rely on a lot of leverage, that can get them into trouble. The other thing that could impact real estate, particularly today, are changes in technology, the ways we live and work. So if you think about enclosed shopping malls, they were, from really the post-war period until a decade ago, the best assets. A large shopping mall anchored by department stores, lots of retailers, food court, they grew value 5% a year unleveraged, 40, 50 years, because they were very hard. They were really fortresses. And what's happened, of course, is the internet showed up, e-commerce showed up, and that's really impacted those businesses, and we've seen sharp declines. But that happened over a long period of time. So it can be secular changes in the way we live and work, but the bigger thing generally, to your point, has been leverage.
Some people say that real estate is favorably taxed by the U.S. government. I assume that's because of depreciation and other kinds of things. But now one of the most favorable parts of the tax code for real estate has been something called a like-kind exchange, known as a 1031 exchange. The current President Biden, has proposed changing that. Will that affect real estate very much or not?
I think it'll affect individual investors who've owned assets for a long time, will harvest gains and then buy a new piece of real estate. For the institutional investors, it's less of an impact because we're selling, we're paying taxes. The way it may impact us is if there's less selling as a result. The same thing could happen if capital gains go up. You could see some individual owners of real estate be more reluctant, but I don't think as much of an impact on the institutional market.
Talk about geographies for a moment. We're in New York City now. New York City has seen a lot of people leave during COVID. They're in the Hamptons or wherever they are. Do you expect that people will come back, work 5 days a week, and use all the office space in New York or similar cities that they did before, or is there going to be a need for less office space?
When we think about our company, we know we're better together. Our business, we don't have the formula to Coca-Cola. We have a lot of smart, talented people who are connected by culture. And so I think being together matters. Now, yes, I think some companies will conclude they don't need quite as much space, and so that'll create some additional vacancy. People will be concerned about owning office buildings, and that may create an opportunity because there'll be some headwinds for a number of years, and then over time, things will recover.
A lot of people have moved to Florida and let's say Texas, maybe for warm weather, maybe because those states don't have income taxes. Do you think that trend will continue, and is that a good place to invest in real estate now because more people are moving there?
I would say it's a bit of both. I think the weather, the lower cost of living, lower taxes, particularly in a post-SALT world, concerns about quality of life, crime. I think the migration has, Texas is one of the fastest growing states in the country, even though it's enormous. I think that will continue, and it was accelerated a bit by the pandemic. On the other hand, New York City, San Francisco, these are amazing places. And when you think about technology and innovation, entrepreneurship, immigrants, people are going to come to these cities. My daughter's graduating from college. They want to live here. So I think there will be a rediscovery of these cities, but I think longer term, the policymakers in these cities can have a big impact. We saw it obviously in the 60s, 70s, and 80s when these cities suffered. I don't believe that's what's going to happen. And I think with the right policy, I think these cities can really thrive. But yes, Texas and Florida are well positioned.
So when you were growing up, and certainly when I was growing up, I'm older than you, people really wanted to own their own house. It was part of the American dream, own your own house. But you've been buying a lot of rental housing now. Is that because you think young adults are not as interested in buying their own home and they want to rent now?
No, there could be some of that. But if you look in the last 12 months during COVID, there's been a surge in people wanting to own homes. I think our investment, or I know our investment in rental housing, is based on the fact that we just haven't built a lot of housing since 08-09. So we've averaged less than 1 million homes built in the United States during that period, versus probably the 1.5 million we need to keep up with population and obsolescence. And so that's created support for single-family values, but also rental values. And I think now as the economy reopens here, I think this shortage in housing will become more acute. And so we continue to like it as a sector to invest in. Go where the creative and technology types are. because those are the markets where there'll be the most economic activity.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
So what's the pleasure of being a real estate investor, which you've been doing for almost 30 years, as opposed to being a private equity investor or being some other type of investor? What is it that you liked about real estate that kept you in it for 30-some years?
I would say I love the people. I love learning about all these different places. I mean, I got to see all of the United States, virtually all of the developed world. You know, when you're investing in, I have real expertise about the efficacy of this drug versus that drug. But as an individual, you can say, I've been in a neighborhood here, I'm in Oakland today, gosh, it feels a lot like Brooklyn did as it started to gentrify. I'll connect the dots and do this. So I think the tangible nature of it, the experience, if you love to travel, if you love to see places, I think real estate's hard to beat.
Right, let's suppose somebody's watching this and they say, okay, this guy has done a great job of building a great real estate business. I want to invest with him, or I want to invest in real estate. For the individual investor, what is the best way to invest in real estate?
So for the individual investor, I'd say there are a couple of ways. One is there's a public REIT market where you can invest in some excellent companies here in the United States. There are REITs, frankly, around the world. That's one way to do it. Another way to do it today is we have things called private REITs. We at Blackstone have a vehicle called BREIT, East and Southwest of the United States. And that's another way to do it. There are others who offer similar products. For some who are more adventurous, they can partner with local developers, let's say. The challenge I worry about that is just misalignment of interests and liquidity. How do you get out at some point, investing, and you're generally not getting a lot of diversity in that approach.
Well, are you worried about the economy now? Its economy's been pretty good, but it probably will head down at some point. The economy is always correct. So if I say I want to invest in real estate, is now a good time, or should I wait a while before the economy corrects?
I think it's still a pretty good time for real estate, and I'd say it for a couple of reasons. One is the warning signs for real estate are twofold. Too much leverage, too much capital, and we don't really have that in the real estate system today. The other, too many cranes, too much building, and we're actually below historic levels in terms of new supply. The other thing I'd point out, if you looked at the S&P 500, it's delivered something like 4 times the return of public REITs since the beginning of 20, before COVID. So real estate is lagging coming out of the recovery because obviously people have been concerned about the physical world. I think real estate here, as the economy reopens, people go back into spaces, is going to see a little bit of a bounce. I think the risk is do interest rates move a lot? That's a bit of a threat. I would say one positive thing about real estate also is inflation, remember, drives up the replacement cost of buildings. And that gives you a little bit of a cushion on existing real estate.
Where should I not invest my money?
You should stay away from buggy whip businesses. You should stay away from landline phone companies and some of the legacy retailers, some legacy media businesses. You want to focus on the future. And I would just say this on real estate in particular, if I had one piece of advice, where geographically, is go economic activity. So the West Coast of the United States, Austin, Texas, Cambridge, Shenzhen, London, Amsterdam, Tel Aviv, Bangalore. Tech is driving so much of the growth in this global economy. Those are the most interesting places to invest.
Okay. Do people come up to you at cocktail parties? Remember what cocktail parties were when people used to get together? They ask you for any investment advice, and you always say, just invest with my firm, or what do you give people advice?
People, it's funny, they often ask me residential home prices, which is not my area of expertise. And, what I tend to tell people is focus on the longer term. Focus on, I think the danger of the world we live in, the sort of Snapchat, TikTok, meme stock thing is dangerous. And what you want to say is this fundamentally a good business? Is it in a good sector? Is this a good piece of real estate where supply is limited, demand is favorable? And if you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
John, thank you for a great overview of the real estate investment world, and I appreciate you giving us this time.
Thank you, David. It's been terrific.
The past 18 months have reminded us how essential the PC is to work, life, learning, and connecting. And with Windows 11, we have renewed sense of the role Windows plays in the world. It offers personal agency and real choice to users.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies?
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year. And so our approach is to use the vote and engage with these companies over time.
But that's always been the case. I mean, at least in theory.
111 million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
Politics from U.S. elections, prose from COP26, and a poetry haiku from the Federal Reserve. This is Bloomberg Wall Street Week. I'm David Weston. This week, former Bank of England Governor Mark Carney on enlisting the banks to fight climate change.
They see a lot of offensive opportunities and only more to come in the future.
Former Treasury Secretary Larry Summers on the Fed's calm attitude toward inflation.
I think we're taking a real risk that we're setting up for a very serious problem.
And Lazard's CEO Ken Jacobs on how his business is changing because of ESG.
On the asset management side of the business, absolutely. That's changing rapidly.
Just about everyone got their licks in this week, from U.S. voters telling the Democratic Party to think again, as described graphically by Democratic strategist Howard Wolfson.
I mean, it was a bloodbath.
To European Commission President von der Leyen telling the world it needs to pick up the pace on climate action.
We all must speed up our race to net zero. We're running out of time.
But in the end, it all came down once again to the Federal Reserve and its chair, Jay Powell, who went out of his way to calm the markets, announcing finally that the Fed would begin to taper its bond buying program, but that it is in no rush to raise rates.
Our decision today to begin tapering our asset purchases does not imply any direct signal regarding our interest rate policy. We continue to articulate a different and more stringent test for the economic conditions that would need to be met before raising the federal funds rate.
When we heard from Chair Powell on Wednesday, he said our monetary policy ultimately depends on the labor market. And then on Friday, we got surprisingly strong numbers for jobs growth, adding over 530,000 in October and revising up the numbers for September to over 300,000. The markets took the week overall as pointing to risk. The S&P was up 2%, the fifth week in a row. That's the longest streak in over a year. And the NASDAQ rose even more, up 3%. But all that equity action didn't hurt the demand for bonds, as the yield on the 10-year fell 6 basis points to end under 1.45%. To give us an investor's perspective on all this, we welcome now Afsaneh Beschloss. She's founder and CEO of Rock Creek. So, Afsaneh, great to have you back with us. Always is. So give us a sense. It sounds like right now we can have our cake and eat it, too.
It's great to be with you today, David. It was really interesting because the 15 billion tapering every month. At the same time, he made it quite clear that other market expectation that, when tapering is done in July, we would probably start having the rate increases may or may not be the case. So I think in terms of eating our cake, absolutely, we can continue having growth. We can, as you said, we had the yield curve steepen. We had the markets, up 6 times in a row. That was quite exceptional. But I think what a lot of people did not maybe pay a lot of attention to is what happened over in the UK with the Bank of England, which has, I think, some relevance to what Chairman Powell may be having in mind as we get into next year. And that was the markets expected interest rates to be increased in the UK, and that did not happen this week. And a lot of people lost their shirt. And I think what Chairman Powell is saying is he does see the one condition of inflation where he expected it to be, which is more than 2%, and it is. And there are lots of conversations whether it's going to be higher or not by a lot because of the supply chain problems. But more importantly, he and I think in the past, Janet Yellen are two Fed chairmen who have really, really talked about not just the numbers that we see, like the ones you mentioned, the 530,000 today, which, by the way, had 200,000 women in it. And that's very important because women are starting to go back as schools are opening. But a lot of people are still sitting on the sidelines. And he talks about maximizing employment. So he's looking at it much more from a maximizing employment, looking at lots of different dots. And also, we should really watch what they're saying much more carefully, just like I think we were surprised by UK. If you let me, I just was, reminded of a Stan Fisher quote because he gave this great lecture yesterday at MIT. And Stan, who was a former Fed vice chair, once said that central bankers are, it's a dangerous place to be a central banker because they can print money. But he also said central banking is something like a pointless painting. You have all those dots of data and you're trying to figure out what on earth is the picture. Yeah, and I think that is the problem.
And I'm sorry, when you talk about those people on the sidelines, it points to participation numbers, which are stubbornly not going up particularly well. But if you're an investor, it's not just the yield, it's the real yield. You have to take into account inflation. And one of the questions I have is, we had Chair Powell masterfully keep the markets nice and calm. Is that really what he wants to do? Is he going to fight inflation by doing that? Because actually financial conditions actually loosened rather than tightened when he said he would taper.
They did, and I think he will be much more careful. But again, this focus on what he has said very clearly, employment, I think, is sort of really, really up there for him. And so he will be watching inflation at the same time. But if we do think that with the supply chain problems that are there, we will have less of a problem. One, because growth rates will be lower next year in the US, in the rest of the world, in Europe, and in China. You may not have as big a problem. And so your real yield, which is what you're talking about, may actually do better because, inflation may start going the other way around. So I think that's sort of the way he's implying his thinking is, and that's the way we actually think at Rock Creek too.
So as a practical matter, I hear from a lot of people, it's just hard to find yield, period, because there's so much money in the marketplace at this point. We had, of course, the COP26 talks that you were very involved in over in Glasgow this week. And I wonder, as an investor, what are the opportunities there with climate? Because I hear a lot of lofty goals being announced. At the same time, I'm not exactly sure how it's translating into the real world of investing.
By the way, one point we should mention is, I think, maybe there have been others in the past I don't know about. Jay Powell may be the first Fed chairman who, before he joined the Fed in his earlier role in the Fed, was actually investing in sustainable climate-related investments. So I think it's a point that he doesn't talk about too much, but interesting. In terms of investments, I think to look at the positive, obviously there is the most important point that has been highlighted in COP26, which is finance is key. Asset allocation is key. There's so much asset sitting on the sideline right now, as you said, earning negative returns in fixed income. So if you have if you can move those assets to positive returns and in a sustainable economy, it will be very, very helpful to everybody. And, we at Rock Creek have signed up with a number of the alliances in particular. But as you said, it's not signing up and committing that matters. It's actually what you're going to do. And we saw with the Oxfam report, right now, the 1% top, most wealthy people are responsible for more than 16% of the emissions. And that number is expected to go up in the next 10, 20 years. So going back, I'm positive about opportunities. I'm really concerned it's going to be much, much slower, David, in terms of putting them into action and maybe making people think they have to get to net zero without giving them a transition plan of how you get to net zero is a big problem, which nobody is really talking about.
I guess one of my questions, Afsane, is, if I can put it this way, when we talk to about all this capital going into green investing, is it a push or a pull? And by that I mean, are the opportunities so attractive that people would be idiots not to go into it? It's just so attractive. Or do they need a push, whether from governments or otherwise?
I think there is definitely a lot getting done as we speak on the technology end, creating new batteries that will have longer life, more storage, and also potentially other forms of energy. So there's that going on. And if, as we've seen, those could have very, very high rates of return. In fact, David, some of the highest return investments in the last 12 months were in venture in clean energy. So there's certainly a return perspective that we should not forget. At the same time, solar energy is very cheap now. So if you invest in transmission or development in solar, the returns are not going to be high. So the question is, so long as they're positive, is it higher than the negative returns that many, many bondholders are holding? And can the financial system create tools that allow people to go into it? So going back to your point, I think it's a pull and a push. The only thing that I have found has changed in the last year, but particularly the last few weeks around COP26, is a lot of universities and endowments have changed their tune, and they are truly looking at how they can improve the endowment management, which was very far behind in terms of climate, but also bringing in their scientists and people who are running the university operationally to see how you run a university on net zero. And David, they still are looking for answers. So I think a lot of work has to be done on implementation, not just pledges.
Just very briefly here at the end, Afsane, can we get past energy to things like green steel and green concrete?
I think there is hope. I think we will need a lot of investments going into those areas. I'm very optimistic about those areas. I've seen, some research going into it that will make it positive. So you may be asking the wrong person.
Are you disappointed we didn't do away with coal?
I think it's really disappointing that the U.S. in particular did not sign up for that. And while we had a lot of smaller countries like Vietnam sign up and Indonesia sign up, you had the U.S. not sign up. So that, alongside, of course, China, who did not even appear at the meetings, is very, very upsetting to the market. Yeah. We all know there's a shortage of energy as we speak, but we need to find jobs for the coal, people producing coal, and move on.
Some work left for COP27. Okay, thanks so much to Afsane Bechelas. She's Rock Creek Group founder and CEO. Coming up, we talk with former Bank of England Governor Mark Carney about his project to enlist financial institutions in the quest to slow global warming.
In many respects, it's a watershed. Wall Street and the global financial sector has stood up and said, look, we'll put capital behind these solutions.
This is Wall Street Week on Bloomberg.
Energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting and dealing with it as anybody else is. And I think leaders here are thinking about it the same way leaders are around the world.
When you look at the UK and, of course, some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
This is Wall Street Week. I'm David Weston. The COP26 meetings were dominated, of course, by heads of state this week, but a lot of the big news came out of the financial sector and a huge effort of the financial industry to really support the goals of zero emissions. Those efforts were led by Mark Carney, the former governor of the Bank of England. He's now vice chair of Brookfield Asset Management and, as important, a special envoy of the United Nations. So we welcome now Mark Carney to Wall Street Week. Thank you so much for being with us today. Start with exactly how the world changed because of those huge initiatives. So I understand you have 450 institutions, something like $130 trillion in assets represented. But if I work at one of those institutions, an asset management firm or a bank, how are the decisions I make today different from the ones I made yesterday?
Well, first off, David, thank you for having me on. I love the show. You're an absolute institution, and I'm going to take it, if you will, from a Wall Street perspective. And what it's going to mean for people working there, and a number of them are already doing this, but it's going to go across the organization, is they're going to look when they're making a loan or they're making an investment, they're buying a bond, even trading a derivative, they're going to start taking into account the underlying credit, the underlying company. Where is it on the transition towards net zero? Because after all, we're here in Glasgow. The objective of 195 countries is to get to net zero greenhouse gas emissions. And so this is going to become, a competitive advantage for companies that are moving faster towards that, companies that are part of a solution, and it's going to be a challenge for those companies who have it. So this lens on climate and climate competitiveness, if you will, is going to be applied across virtually all assets, and that's going to be part of the skill set of the individuals who are making those portfolio decisions.
So you know this industry so terribly well. Distinguish, if you would, defense from offense. And this is what I mean by that. It's one thing to say, if I'm working for a bank or an asset management firm, I'm going to really shy away from some of the fossil fuel companies. I understand that. I'll call that defense movement. But does this encourage companies to go on the offense, for example, to invest in green steel?
Look, David, absolutely. And that's the big shift here, I think, that we've been aware of the risks around climate, and the most obvious ones are when New York gets hit by an extreme weather event and there's big property losses, or supply chains are disrupted by another event on the other side of the world, and we have those effects and we have to manage those. But there are huge opportunities in being part of the solution. And so the offense here is very, very broad. Of course, it includes, and in my professional life, I do a lot of this at Brookfield, one of the largest renewable producers in the world. It includes building out wind, solar, hydro, eventually hydrogen and other technologies that produce electricity with no emissions and are part of very much central to our future. But almost as interesting and really more valuable is going to companies that have high emissions today. You rightly mentioned the steel industry, or the auto industry, or the cement industry, the building industry, commercial real estate, others, and helping them get emissions down. Now, it takes a lot of capital in order to do that, but it's going to pay off in terms of a huge amount of value. And so on the range of solutions and investment opportunities here, you have technologies that are just going to take existing activities of, whether it's HVAC, heating, ventilation, cooling in buildings, or grid optimization for electricity grid, and just get the emissions down from existing plant. Next to that is putting in place new technologies, new investment that itself gets emissions much more dramatically down. And then farther out the risk spectrum are those technologies that'll be very much part of our. And I referenced green hydrogen a moment ago, and that would be a classic example. The more extreme breakthrough technologies, I put it in the venture capital camp, are technologies around, for example, direct air capture, sustainable aviation fuels. So the whole range of the investment spectrum is available. And look, your question is very on point. This is much, much more about offense. It's much, much more about getting capital to solution. And candidly, that's why we need like $130 trillion to be focused on addressing this issue.
So speak to those investors. As you describe this, what we're calling offense, investing in things like green steel and the like, do investors have to get used to lower returns as a practical matter?
No, I don't think so, and certainly not on a risk-adjusted basis. One of the things, now for a moment, David, I'm going to speak about defense, unfortunately, which is one thing investors increasingly will need to do is think about terminal value, think about where certain assets are going to lose value and potentially lose value quite rapidly because they're not decarbonizing fast enough, or they're just not suited for a low and zero carbon economy. You referenced part of the energy sector, fossil fuels. There's elements of that which will not be there, or certainly can't be there if we're going to get to where we need to go. So investors need to look at that.
Well, Mark, you are spearheading, if I could put it that way, a major transformation, a transformation of the likes of which I can't think of alike in history, frankly. You can't have that big a transformation without some costs along the way. There's no such thing as a free lunch. You say perhaps returns will not be reduced in this area. What about costs? Because as we make this transition, there's got to be disruption somewhere.
Yeah, look, David, transforming the energy system, it's better to start early in order to have a smooth transition. But but we haven't started early. Let's be candid. We've left this very late, certainly for the 1.5 degree objective. So there needs to be a very rapid ramp up in renewable power. But at the same time, we need to get it right on the fossil fuel side and have those bridge fuels that are necessary in order to keep the lights on, literally, and keep industry humming as we build up the other side. And there's lots of ways to get that wrong, to have too little too early and have the type of volatility we've seen in energy markets. That's one risk in terms of a bump. Another risk is, look, in terms of this decade, there is a very large number of highly economic technologies where the real issue is just rolling it out at scale. Slightly easier said than done. You got to get planning permission. You need the right companies, etc. But it's not yet. It's not technology risk for what we need to do to get emissions down sharply this decade. In the 2030s, it is some technology risk. There will be a lot of bets on, I suspect, on elements of hydrogen that don't work out. There will be some big venture capital effectively bets on capturing carbon from the air, direct air capture of carbon that don't work out as the nature of any VC bet. So there will be volatility, and you're right to emphasize the scale of it. Although, last point, relative to doing nothing, which is more or less the strategy the world had been pursuing up until recently, these bumps are nothing compared to the cost that would come.
Yeah, a really powerful point. Thank you so much to Mark Carney. He is the Vice Chair of Brookfield Asset Management. Coming up, we take a look at the week ahead on Global Wall Street. This is Wall Street Week on Bloomberg.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference. This week on Bloomberg Television and Radio.
This is Wall Street Week. I'm David Weston. It's time now to take a look at what's coming up next week on Global Wall Street.
Well, David, this week the spotlight is back on China tech. Tencent earnings, they could confirm that the worst is over of the government's crackdown. Meanwhile, Alibaba puts on its Singles Day event. Now, this is bigger than Black Friday and Cyber Monday combined. The festival theatrics, though, looking to be a little bit more subdued this year. Still in China, there are more debt deadlines facing property developer Evergrande. Plus, we'll have the latest from the APEC Leaders Summit. To Danny Berger in London now.
Thanks, Annabelle. Well, it's the second week of the COP26 climate conference in Glasgow. They'll be wrapping up negotiations on Friday. They'll likely release a text of those negotiations where we're expecting them to reaffirm some of the Paris Agreement climate goals. We also have meetings in Brussels next week from both ECOFIN and Eurogroup meetings. Then there's a large private equity conference in Berlin that takes place all next week. We'll have all of the typical private equity giants there, and Bloomberg will be live on the ground for it. It's also another week of many earnings. You have about 1/6 of the stock 600 in Europe reporting next week. It includes pharma giants like Bayer and AstraZeneca, as well as some insurance companies like Allianz and Munich Re. Now let's get over to Romain Bostic in New York. Romain.
Thanks, Danny. A major milestone ahead that could add fuel to the economy. The United States will open its borders to vaccinated foreign travelers on November 8th, marking the biggest easing to travel restrictions imposed during the COVID crisis. Elsewhere, there is some economic data to keep an eye on, including inflation numbers. The average estimate of economists surveyed by Bloomberg sees the fastest year-over-year increase in prices paid by U.S. consumers since 1991. I'm Romain Bostic in New York. Back to you, David.
Thanks to Annabelle, Danny, and Romain. Coming up, how do all those zero emissions goals translate into real actions by the people who are doing the deals and managing the assets? We talked with the chairman and CEO of Lazard Frères, Ken Jacobs.
I would say most of asset management is investing defensively around ESG, and I think that's going to shift over time.
This is Wall Street Week on Bloomberg.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
Zero carbon emissions. It was all the talk this week at the COP26 meetings in Glasgow, with European Commission President von der Leyen urging faster action.
We all must speed up our race to net zero. We're running out of time.
And President Biden saying the United States will lead the way.
The United States is not only back at the table, but hopefully leading by the power of our example. My administration is working overtime to show that our climate commitment is action, not words.
But if we're going to have any hope of making real progress on emissions, it will take more than governments. It will take a massive effort of the private sector. Bank of America's Brian Moynihan says banks like his are feeling the pressure.
There's a lot of pressure on banks because our clients are demanding this. Our investors are demanding this. The politicians, the world's demanding this.
And Luke Ellis of the Mann Group says that with more guidance, the private sector, and especially hedge funds like his, can help get us where we need to go.
The clearer the roadmap we can get from politicians about what they're going to do, the more that the private capital markets can actually make the transition happen. In the end, there's a lot of good words are going to come from government and regulation is going to come from government, but a lot of the capital that's required to make the transitions has to come from the private markets.
Lazard Frere is on the front lines in arranging acquisitions and mergers, also in managing nearly $300 billion in assets. So when it comes to figuring out how the lofty goals of COP26 may translate into the real world, there's nobody better than Lazard Frere. And we're joined now by the chairman and CEO of Lazard Frere. He is Mr. Ken Jacobs. Welcome to Wall Street Week.
Thank
Good to have you here.
Thank you. It's a pleasure to be here.
So we've heard these lofty goals. Everybody is signing up for them. But what does it mean in the real world? As you're doing deals, as you're managing assets, is it changing what you do?
On the asset management side of the business, absolutely. That's changing rapidly. On the advisory side of the business, which is arranging mergers and acquisitions, that's on the come, so to speak. We're seeing the beginning of it, but it's not quite there yet. Let me speak to the asset management side to begin with. One has to step back and realize this has been in play now for several years. The first thing that happened is the core demographic that drives activity in the economy started spending their values. That was a couple of years ago, 3, 4, 5 years ago in the United States, longer in Europe. Over the last couple of years, it has shifted now, so that same demographic is starting to invest their values. And that's playing through in the asset owners, and it's really having a big impact on the asset management business.
So when you talk about investing in assets, is it defense or offense? And by that I mean this. It's one thing to say, I don't want to invest, for example, in a fossil fuels company. Okay, I get that. But what about affirmatively investing in a green steel company?
I think in the beginning, it's going to be defensive because at this moment in time, there's very little that kind of ties green performance, whether you are your emissions policy, your social policies. There's very little that actually ties that to performance in the stock market or cost of capital. That's at its very early stages. But scoring companies is there. So I'd say at this moment in time, we're probably doing, I would say most of asset management is investing defensively around ESG, and I think that's going to shift over time.
We heard from a former Vice President Al Gore this week saying that we have something of a, I think he called it a climate subprime crisis coming, because there's trillions of dollars in assets in coal and in other fossil fuels that may not be worth actually what we think they're worth because they'll never get used. Is there a looming problem with that?
In the long run, yes. In the short run, in the medium term, we're going to have many ups and downs. You know, a year and a half ago, when oil was trading at a negative value, who would have predicted close to $100 oil price a year and a half away? So I think what we're going to see is a lot of what I would almost describe as uncertainty and outlier kinds of experiences over the next several years. I think in the long run, he's probably right. As we make that transition to the energy transition to renewables and to more green types of energy, that will happen. But in the short short and medium term, we could have a lot of ups and downs.
So what do you do as an asset manager in that circumstance? Because we have a short-term supply problem, for example, natural gas in Europe, and we've seen the prices spike up, and we've seen energy companies' stock actually go up. So in the short run, you actually might be able to make some money because the market may have overly discounted the value of those stocks.
Yeah, well, I don't think it's as black and white today as that asset managers can't invest in oil and gas and energy stocks. I think we're slowly, maybe even more rapidly than some would like, moving in a direction where it becomes less attractive to do that. But at the moment, there's still ways for people to invest and make money in the short and medium term on those kind of spikes and movements in price.
At this point, are there enough really attractive alternatives on the green front? Now I'm talking about the offensive part, whether it's solar or whether it's new technology. I've to be done?
Well, I think that's going to, again, I think it's going to evolve. As you start to build in the incentives, both from the standpoint of where capital goes, and I mean, if as an example, there's a real incentive for people to invest in green projects, then the cost of capital for those projects goes down, and those projects become more attractive to invest in. And I think we're going to see more and more of that as time goes on. Also, the investment that's taking place in technology, everything from storage to wind, solar, that have taken place over the last couple of decades have made an enormous difference in creating opportunities in this area. And I think that's just going to continue.
So as you look at possible assets to invest in, how many things do you find that you can invest in that really have attractive returns? Do you have to get used to taking a lower return as a practical matter to accomplish some of the ESG goals?
Not necessarily. Again, one has to look. On one hand, you can look at what's happening in the electric vehicle space, and you can see Tesla at a plus $1 trillion valuation, Lucid and a couple of the other car manufacturers at $60 billion. This is an area where there's just been enormous investment and just spectacular returns for people over a period of time. I think we're going to see opportunities here for a long period of time, as long as people believe we are really moving to that we're really on a path for energy transition. If, on the other hand, this reverses itself, which, frankly, I don't think is going to happen because of this, what I would call this demographic, this economic demographic that's really pushing this, I don't think it's going to reverse, but should it reverse, it changes things. But as long as people think we're on this path, then these technologies, then there's going to be an enormous investment in these technologies, because the payoff is going to be huge.
That raises the question of where we are on the path. I mean, all of us have learned maybe the hard way that if you can't measure, you can't manage it. So how do we measure this? How do we know where we are on that path and whether we're making progress, even if we really want to badly?
Well, I think there are some indicators. 15 years ago, one would have, or before the financial crisis, when oil and gas prices were spiking in 05, 06, one would have said there's no point in investing in renewables. How do you compete in geothermal? How do you compete in solar? How do you compete in wind? And prices have come down 70 to 90% since that point in time, which have made all of those technologies at a much lower oil price, in fact, and a much lower natural gas price competitive. Today, those technologies are very competitive, and that's the kind of investment that's going to take place. You come down the cost curve, it drives that. We're likely to see that over the next decade or two around hydrogen. We're certainly like to see that. We're likely to see that around storage over the next couple of years, over the next decade as well.
So that raises the question, in my mind at least, about the government. Because if the markets are taking care of it, maybe we don't need the government to do anything, or do we need the government to set some of the rules for us?
Well, I think there's two places the government can be really helpful. The first is in setting the rules. There are going to be standards around disclosure that are just going to be necessary to create a level playing field for companies and also for investors. And I think the SEC is moving, it appears to be moving aggressively around that. The second, and along the same lines, the accounting standards around disclosure are going to be very important as well. So some standard setting around that is really important. The second thing government can do is it can pick a few areas where no one else can invest efficiently to make a difference. Just as an example, in the infrastructure bill, there are two areas that the Congress is focused on and the administration is focused on. One is around EV infrastructure, and the second is around the grid. Those are two examples where if you can accelerate that, or you make that work, then it makes the transition from gas vehicles to electric vehicles just much more efficient, much quicker, because electric vehicles, of course, need to worry about the EV infrastructure, and ultimately, the grid is going to become even more important than it is today with electric vehicles.
For an investor, how important is it that there be international cooperation on this? I mean, because otherwise we could have countries competing with each other in a bad way.
Absolutely. There's got to be some standards, because you can imagine a scenario where one geography, let's just say the European Union decides, look, we're going to start taxing carbon differently on products coming from the United States if they don't have the right policies, or from China if they don't have the right policies. So you can end up in a pretty protectionist regime pretty quickly if you don't have common standards globally.
You said when it comes to ESG for Lazard Frères that the asset management side is a little bit ahead of where the merger advisory side is. Where is the merger advisory side?
Well, what I would say first of all, on the asset side, we've made huge investments to really position ourselves in this area. On the advisory side, we're doing the same thing. We're launching a climate center in December, and one of the first areas we're going to be focused on is the impact of the energy transition on cost of capital and ultimately stock price. There's very little evidence in the market today, or literature in the market today, that really takes and ties those two together. That's going to be critically important in terms of understanding how to value transactions that are either carbon accretive, carbon dilutive in an M&A context. And I think that's going to happen over time.
Ken Jacobs, Chairman and CEO of Lazard Frères, thank you so much for being with us on Wall Street Week. Coming up, we wrap up the week as we always do with our special contributor, Larry Summers of Harvard. This is Wall Street Week on Bloomberg.
Is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris. We talked about this. We talked of other things. Now that's moving to become mandatory.
This is Wall Street Week. I'm David Weston, and we turn once again this week to our very special contributor. He's Larry Summers of Harvard to take us through the week. First, let's start at the end of the week, Larry. We got the jobs numbers out for the United States. Better than expected, pretty robust, not just for last month, but also revising for the prior month. What do you make of these jobs numbers?
Look, it fits what I've thought for a while now, David. We've got a very, very strong economy on the demand side, and not a very strong economy on the supply side, and that's risking an overheating. You saw a lot of job creation. You didn't see an increase in labor force participation. You saw a rapid average hourly earnings figure, but if you adjusted for the fact that most of the people coming back were in leisure and hospitality where wages are relatively low, it was an even stronger wage figure. I think we're still not running policies that are consistent with the reality of the economy. The reality of the economy is that we've got a interest rate far below the neutral interest rate, and we've got a tight labor market. And that's a prescription for rising inflation, not a prescription for falling inflation. So I continue to be very concerned about the outlook going out a year or so as the economy starts hitting supply constraints and hitting them hard, given all the pressure on demand.
Larry, I wonder if there's a connection between two of the things you referred to, the participation rate on the one hand and the increase in average hourly earnings on the other. Because we've been saying, well, the participation rate went down from the pandemic. It's come back some, but it's not nearly where it was before. At what point, as that continues out, does that become a structural change that actually could have longer-term effects on inflation, particularly wage inflation?
So I think there are 2 points, David. The first is that until 2017, the Fed thought the normal unemployment rate, the natural unemployment rate, was 4.7% or more. So we may well just be there looking at the level of unemployment, and it's clearly headed down from here, not up from here. With respect to participation, I don't think anybody can gauge it. But if you take more mental illness, if you take some concerns as people reassess their lives, as you take a super high level of structural change in the economy, as you take some people because of their fears of COVID or their distaste for mandates moving away from work, if you take the early retirements that probably aren't going to be reversed, if you take the more generous child care benefits and apply the estimates the progressives have traditionally used, that's likely to have some discouraging effect on employment. If you take all that together, I don't think we've got a strong basis for thinking that participation is going to rally in a major way. It might not, it might happen, but for that to be the major planning assumption seems to me to be taking a big risk.
So, Larry, hook that up, if you can, with what we heard from the Federal Reserve this week, and particularly from the chair, Jay Powell. He certainly seemed to say in the news conference that really, when it comes to the question of tapering, he's begun, but particularly rate hikes, that's going to be determined by what happens with the labor force. Is he right about that? And is it possible for him actually to be too gentle in the messages he's sending to the markets? Because certainly the financial conditions did not tighten at all.
Look, what the Fed controls is financial conditions. If you look at financial conditions as measured by real interest rates, if you look at financial conditions as measured by asset prices, they are looser than they were before Jay spoke on Wednesday. They are looser than they were a month or two ago. We've got rising inflation and we're not tightening financial conditions. That's why I fear that we are on a risky course. Now, the argument that thoughtful people like my friend, former classmate Paul Krugman make is that there's some risk aversion principle that we've got to do this because it would be so catastrophic to run a recession, and inflation is a manageable problem. I agree that we've got to guard against risks, but here's my view. My view is if we let inflation accelerate, there's almost no proven ability of the central bank to engineer a soft landing. And so in order to squeeze out an extra bit of hoped for labor market tightness, I think we're taking a real risk that we're setting up for a very serious problem. You know, if you look ahead of you and you see that there might be all the traffic stopped, you start braking your car as early as you can, even if it means that it's going to slow you down in the event that there is no traffic jam. And that's, I think, the right way to think about the central bank's problem right now.
Larry, another big development through the course of the week was with respect to the infrastructure, bipartisan infrastructure bill, as well as the so-called Build Back Better plan. It's not quite there yet. It's not finalized, but we have a pretty good sense of where it's going. What do you make of what we're seeing, both on the what we're spending side and how we're paying for it side?
Look, I hope we get this done. I hope both bills pass, the bipartisan infrastructure bill and some version of the so-called reconciliation bill. There's sure a lot of effort going into building better, build back better, and I hope it works out. I also hope people are going to keep a very, very close eye on this, since at the very last stage, that's when abusive provisions or misprovisions are sometimes put in. I'm glad to see that the provisions on SALT deductions look like they're being modified somewhat. It would have been a real tragedy, David, I think, if the provisions had ended up being written in a way where people in the top 0.1% of the income distribution got a substantial tax cut. I think we're moving towards fixing that. But look, these are investments that our country should be making. It's also not too early to say that it's not the amount of money you spend and the nobility of the cause you spend it on, but it's how well you spend the money that matters. Are infrastructure projects going to produce a better infrastructure, or are they just going to help the businesses that provide infrastructure services? It's going to be really important, both in terms of the effectiveness of the investments and in terms of the American people's confidence in government, that this money be spent well as being spent on a significant scale.
Larry, one last one. Last week, you and I talked about the COP26 talks, which were upcoming in Glasgow. We've now had them. You expressed some concern, even doubt, last week that they would be able to do enough to really get us on the course we need to go. Did they?
I'm still worried, David. You know, I learned as a fundraiser that when people wanted to say a really polite no, what they would do is talk about a much longer horizon and a much more ambitious goal. And I felt like there was a fair amount of that going on in Glasgow. And I'd like to judge things a little more by what people are actually going to get done and committed in the next 5 years, rather than the aspirations they're going to set for decades from now.
It's such an important lesson. Just briefly here at the end, what do we need to do to have concrete things to be done in the near future?
I think how rapidly we're moving to, in a very supportive way, replace coal-fired power plants with renewables is going to be an absolutely critical test. I think globally, we are still spending trillions of dollars on fossil fuel subsidies. And the single most important thing I would be looking at is not the credits that we give to renewables, not the penalties we impose on fossil fuels, but just the pace at which we reduce those fossil fuel subsidies.
Such an important way to look at it. Thank you very much. That's Larry Summers. He's our very special contributor right here on Wall Street Week. Coming up, one more thought. When is the Magic Kingdom not so magic? That's next on Wall Street Week on Bloomberg.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Senator, with all this pressure on you? Is this fun or is it not that much fun?
My dad always said, if you can say no with a tear in your eye, you might be okay. And I've been crying a lot lately.
Finally, one more thought. Hotel California moves to Shanghai. None of us anticipated how long this COVID thing would last. Certainly, President Trump didn't when he talked about getting rid of it in April of 2020.
Looks like by April, in theory, when it gets a little warmer, it miraculously goes away. I hope that's true.
But coming up on 2 years later, it feels sometimes like this will never end. We've now lost over 750,000 people here in the United States and around 5 million around the world, while the economic disruption just continues right to the present day, as Fed Chair Jay Powell admitted again just this week.
We were on a path to a very different place. Delta put us on a different path.
And inflation? Well, Kristalina Georgieva of the IMF says it's really just a vaccination problem.
Preferably, we should see tempering inflation. And how can we do that? Well, focus on reducing this divergence. Vaccinate the world so we can see production everywhere stepping up.
Nothing could compare with the loss of life and the economic dislocation. But let's be honest, there's also the sheer annoyance of still having to deal with it all. The wearing the masks that leads airline passengers to become violent. And as Ed Bastian of Delta tells us, get banned from traveling permanently.
We've had a few incidents, not a lot on Delta, but anyone that doesn't want to wear a mask and they're on board, we give them the option to either wear the mask or they're taken off the flight and put on our no-fly list. And we've had about 2,000 people that we've put on the no-fly list, the permanent no-fly list, over the course of the pandemic.
But as frustrated as you might be, you can take heart. You probably don't have it as bad as 34,000 people who went to visit the Disney theme park in Shanghai. They all went with their small children for a magical day. But one person tested positive for COVID. They closed the park, wouldn't let anyone leave until every single one of the 34,000 people had been tested. It took until about midnight. You can imagine what that would have been like with your 5 or 6 year old child. And to add insult to injury, in the end, no one else tested positive. I guess better safe than sorry, but like the Hotel California, you can check in, but you can never leave. At least not until you had yet another COVID test. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. That does not mean that we should be naive in the way that we look at our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I've said this many times, it's worth repeating. I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
Today's $2 billion buyback is an important step, I think, and it shows confidence that we have in the underlying performance of the business and outlook, and shows a commitment to try and normalise our capital base.
I think that SPACs are very much here to stay.
You can trade anything as a trend follower.
When you think about Bitcoin, I don't think it's a currency. I think it's a commodity.
Today, we're in an everything bubble.
I'm Eric Schatzker, and welcome to Bloomberg's Front Row. Today I'm talking to Lloyd Blankfein, the former chairman and CEO of Goldman Sachs. For 12 and a half years, Lloyd held one of the most powerful jobs in corporate America. He steered Goldman through the financial crisis and the uncomfortable scrutiny that followed. For decades, it was normal, even expected, for Goldman chiefs to build a second career in government. These days, the road to Washington is a minefield for anyone from Wall Street.
I would have considered public service because, what else is left? I worked at a high level at Goldman Sachs for 37 years. You want to do something different and make a contribution. So it's something that, might have, but I'm not mourning it. I understand why it's not happening now.
Lloyd is keeping busy and doing a lot of trading. He and I talk about his views on Robinhood, Wall Street bets, and crypto, the future of New York City, when CEOs should and shouldn't speak out on ESG, what he wishes he'd done differently at Goldman. Here's my conversation with Lloyd Blankfein. For 12 and a half years, you held what was arguably the most powerful job on Wall Street. What's it like now, being the former CEO of Goldman Sachs?
Bit of a relief. I'm not sure it was the most powerful. I spent a lot of time arguing against that, and I always thought to myself, gee, if I'm so powerful, how come I'm taking so much abuse?
How are you keeping busy?
Well, here we are chatting. Somehow I'm not scheduled. I don't set my clock most mornings. And somehow I get to the end of the day, and I've been busy the whole day. I spend a lot of time reading. I try to learn stuff. Originally I thought, and I wouldn't preclude going back and doing something else more intense, certainly, than the life I'm leaving now. I originally thought and was advised to take a gap year, and then when I finished my gap year, the country decided to go on its own gap year. 1 year plus gap year. So those consecutive gap years leave me in this place. And I'd say the longer you're not setting your clock in the morning, the less you want to set the clock in the morning. But after 40 years of running around the world and living in the macro markets and knowing the price of everything all the time, and knowing that anything that could go wrong anywhere in the world would affect us and have a huge consequence for us, it's a little bit hard to drop it. And there are parts of it that I never thought I'd miss, but I do miss.
What are those things? What do you miss?
Well, I miss even sometimes, even as I say, I feel a little bit of relief in not having someone being intense, but I miss that. I miss the background noise, even of having things to fret about all the time.
Is there such a thing as a substitute for that?
Well, I'm sure there's a lot of people who work at great organizations and have quite fulfilled lives and give their all, and they're not at Goldman Sachs. So there's a lot of other things that one could do. If you're asking me, have I found a passion away from the commercial? I'm a commercial person, and so I'm involved in some philanthropy stuff, and I've elevated my involvement in some things in this period, and I enjoy that. And you could be quite commercial in those places too. You can be a commercial person in government in the sense of getting things done and taking risk and pushing things along, and you could be that way in a philanthropy. But I'm a P&L guy, and I kind of like that stuff, and I like the immediacy of it, and I like the intensity of it.
Your four predecessors as chairman of the firm, Hank Paulson, John Corzine, Steve Friedman, Bob Rubin, All went on to serve in government.
Don't leave out John Whitehead.
Well, there was one in between, right? John Weinberg.
It was the same time as, yes.
Why not you?
Well, I would say among the many reasons, I haven't been asked. So that would have to stay. That would be one of the prominent reasons. It's a little bit of a charged environment. I wouldn't say when you look at the administration, you're finding a lot of people from finance and business backgrounds, even in traditional roles in which, that were occupied by financial people or commercial people or business people. So I would say that it's not something that I mourn, but certainly I would have gone into, I would have considered public service because, what else is left? I worked at a high level at Goldman Sachs for 37 years. You want to do something different and make a contribution. So something that might have, but I'm not mourning it. I understand why it's not why it's not happening now.
I hear Janet Yellen is looking for an exit. What about Lloyd Blankfein for Treasury Secretary? Would you throw your hat into the ring if you thought they were interested?
Who offered that job would decline that. I mean, that's you'd have to be preparing for your end of life or jumping off a cliff or something like that. Of course, that would be to make that kind of a contribution or to be at that fulcrum of that very large lever. Of course, you'd want to do it. But again, I have no real connection to that. I mean, we can go through this, but I don't think that that's going to happen. But it's not going to happen because I'm going to turn down the crown 3 times and make them twist my arm. I don't think the offer is forthcoming.
You dabbled for a hot second with consulting. Tell me about that.
I was I think I was trusted by a number of people who came to me for advice, and guess what? They still did. And for a while, and the line between you do things as long as I did, and engage with with the people that I engaged with, there's not much separation between your business life and your personal life. And so I found myself in a position of, again, rendering advice, nothing, not necessarily official. And then that started to morph where some things started to take a lot of time, and I toyed with the idea of doing it on a commercial basis.
For money.
For money. Nothing wrong with that. But again, it wasn't at the stage of life where I really wanted to get on a horse with a sample case and try to build that business.
Didn't feel right?
I like engaging with people. Look, I think, fortunately, I have very good credentials for crisis management. There's nothing that went wrong anywhere in the world that didn't, again, have an adverse consequence on us, and usually it went along with an accusation that we caused it, whether it was an earthquake or tornado, global warming, everything like that. And so I'm used to working like that. I've dealt with regulators, I've dealt with Congress, and don't forget, we operated in lots of jurisdictions around the world. And so that's a level of experience, and after a while, you could be a dullard, but after a while and enough data points, you kind of know where things are going, and you're in a position to advise someone. I said, look, I know where this is going. Let me tell you where it's going. You might entertain getting there painlessly. It's like, sometimes it's like watching a movie, and someone's getting, talk, get tortured, and they pull out your fingernails and break a few bones, and then eventually you talk. And I'm thinking to myself, gee, wouldn't it be easier to talk before they did all that stuff?
It sounds to me like you think the Fed is doing just about the right thing now.
I respect the Fed for standing up to a lot of pressure. And I think, again, deflation is a terrible thing. Inflation you could tolerate.
inflection
just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 137 right now.
Wrap it
into
up.
Weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
So you're not going to be a consultant. You're probably not going to be Treasury Secretary.
I think I'm not. I'm probably not going to be a surgeon at this point or a nuclear scientist.
But you're 67. You swim every day. You're in good health. What's next?
I don't worry about it. I don't worry about it. I'm not. Look, I'm also a markets guy. I have been. I'm saying that's not how necessarily I lived the last 20 years of my career at Goldman, but it's an occupational hazard that I know the price of everything at times, and so I occupy myself with markets in the background. In the last couple of years, I trade a lot.
Do you?
I do.
In your personal account?
I do. If I do something differently, forget I said this and wipe out the tape. But I didn't really want to look at people and be managing their money and, you know, express regret because, God forbid, you should lose money. But God forbid, a lesser included God forbid, is that you underperformed somebody else who made more money or be on that kind of track. And I'm saying, do I really need to do that now? And so I do my own stuff for myself. I can, you know, my whole life I would much rather have lost my money than lose somebody else's money. And so that's just the way, that's just my wiring.
What are you trading?
I trade equities. I've traded some commodities. I've traded currency from time to time.
You have fun?
I have more fun when it's successful and I'm winning.
Well, tell me a little bit about your track record.
Brilliant.
Come on.
Well, in the period when it started, I couldn't do any of this stuff while I was still at Goldman. I left that at the end of 18, so beginning of 19. Everybody who started in the markets at the beginning of 19 is a genius, because the markets have gone one way. Now, that doesn't mean on any given day, you know, you can look back at a curve and say, gee, that was an easy period, but when you're living through it, you don't know what the next day is. In hindsight, of course, everything is easy, but really, looking backwards, there wasn't a lot of stress. And then this goes, and this has been, you know, much discussed, that asset prices were being inflated during this period. So anybody who invested in almost anything, you know, you had you know, there are some things that didn't go up, and certainly there are always things that don't go up. But on the whole, asset prices were being, you know, with zero interest rates, make asset prices go up.
What are some of your winningest trades?
Oh, come on. I mean, boring as it is, investing in the new economy. I don't want to say tech, but let's say tech enable, the kind of, you know, companies and industries that are tech enabled.
Innovation.
That embrace it. No, of course it's innovation.
Yeah.
I mean, I don't like to say tech because I think tech is, I think to be a retailer means you have to be as adept as Amazon was and Walmart has become. Mm-hmm. To be a retailer, or to be a car manufacturer, you have to be on the cutting edge, or else you'll be a bankrupt car manufacturer. And so everything and anything successful at this point embeds innovation and technology.
Now, I'm curious to know how you do this. Do you do the old-fashioned way? You pick up the phone, you talk to a financial advisor, perhaps that person is at Goldman Sachs, or do you pull out your smartphone and trade on Robinhood?
No, I don't trade on. I'm loyal to my old firm, so I haven't traded, but I don't disparage it. It's not something I do. I have certain kind of pathways that have been operating for a long time, and I stay on them. I look again, occupational hazards. I still wake up in the middle of the night and look at prices, even though I may not be involved, because look, for 40 years, my first job at Goldman was trading precious metals and currencies. And so guess what? 24 hours on the screens. And so those are habits that are hard, that don't die easily. And I'm not sure I want them to. I think it's kind of fun.
In the middle of the night when you wake up and check prices, what's the first price you check?
I look at equities futures, and I look at currencies, and I look at and things that are interesting at different times. Energy prices are interesting, and so I'll look at energy prices. It's not a big deal. It's some people are hobby, some people bet on football games.
Do you do this every day, or is this sort of a few times a week?
I would say every day. Yeah, so many times a day. Again, I grew up with the background noise of markets and risk. I always knew what our positions were, and I always wanted to know whether they were going well or poorly. And I had a role to play. Before I was president and CEO, I was responsible for sales and trading. First, earlier in my career, just the currency and commodities, and later currency and commodities and fixed income, and then after that, currency, commodities, fixed income, and the equities. And so again, it was what I did, and no one could do that for very long if you don't like doing it.
True enough. There's a whole new generation of kids who are just as addicted to markets as you are, and they're on Wall Street bets, and they've got diamond hands on GameStop and AMC and Hertz, and you name the meme stock. Do you think that's healthy?
I think it's a fascinating thing. Part of the business that we're in, giving people advice, managing your own risks, is trying to guess the future. And all you have to go on is a lot of information about the past and maybe some information about the present, which people will fight over.
You spent a long time being an executive and not trading.
Yep.
Now that you're back in the game, are you good at it? Are you beating the market?
I guess everybody's beating the market.
That's not true.
It's like Lake Wobegon. All the kids are above average because it's just been that kind. It's been that kind of asset inflation inflated kind of environment. But I enjoy it. I don't want to spend my whole life only doing that. And I don't do that now. And again, most of the time it's background noise. I'm in favor of leaning on people to get back into the office.
Your business landscape is ever-changing.
There could be a lot more selling to come.
Ours is too.
Just getting some headlines I want to bring to our audience.
The president's saying that this is a pandemic of the unvaccinated.
We have something else in common.
Small caps continuing to feel the pressure.
We seek out the latest business news wherever we are.
A deep drop in Asian equities overnight.
Let me bring you some breaking news in terms of earnings.
Bloomberg Radio, the Bloomberg Business app, and BloombergRadio.com. Bloomberg, the world is listening.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
You talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
Lloyd, you made a choice upon leaving Goldman not to get involved in the firm's affairs and not to comment on how your successor, David Solomon, is doing. How come?
Well, I think I don't think that's some radical notion, first of all.
No, that's not true. Some former CEOs get plenty involved in their companies.
Well, I think that's not the best behavior to do. I mean, you obviously, I root for my old firm. I root for my successor. I am an investor. I don't think it's only my choice to take myself out of involvement. I left the firm. I'm not there anymore. I shouldn't be involved. I don't think people would be interested in I don't drive the firm. I don't govern the firm at this point. I have a good relationship with my successor, but I don't think. I like the post-presidency of George Bush better than the post-presidency of Donald Trump. I don't think I think you have to recognize that the job is tough. If you're an outsider, you don't see everything. You're weighing trade-offs all the time. I'm not privy to the consequences of it, and I don't think it's productive to second guess that.
Do you find it difficult not to be there? Do you find yourself wanting to pick up the phone and talk about things and having to resist that temptation?
Of course, that's why I have a phone that's connected to the system, and I have a rubber telephone that I bought for my grandchild that's connected to nothing, and that's the one I talk to and give advice to.
You were renowned on Wall Street in your industry for, I might call it a laser focus on risk. You put it another way, spending 98% of your time worrying about things with a 2% probability.
Yeah, and I was trying not to look, I run the risk, I didn't want to look too crazy, but I really spent 100% of my time worrying. I mean, I did. It's a job where you worry because nobody knows anything. And nobody can guess the future. Really, nobody can get, some people may accidentally be right from time to time, but nobody really knows. And there's I'd say a lot of the job and a lot of worrying about risk is contingency planning. Not what do you think will happen, but what could happen. And by the way, given enough time, everything not only can happen, but everything will happen.
Put that hat back on. Maybe you never took it off.
I'd like to take it off, but I don't think it comes off.
What are the remote possibilities you'd be most worried about today?
Nothing that ever happens looks in hindsight like it was remote, because it happened. But today, it probably won't be criminality or North Korea. It probably might be a mistake or a flawed program that sells all your assets for a quarter of the value, and you can't pull it back.
An error in some piece of code.
Something like that. That's something that one has to worry about. Not something that's not interest rates going back to what I'll call normal, but normal by history. If everybody owns paper that has been issued at 0.5%, 1%, 2%, and interest rates go to 10-year interest rates go to 5%. Not an unreasonable place for them to be if you look at over history. What happens to the mark-to-market on everybody's portfolio in the world? Any instrument ever issued that's still extant. As a result of low interest rates, people have been taking extra credit risk. Maybe sovereign risk, but extra credit risk in order to get higher yields. That will break people's hearts because things are stable, but if the market gets disrupted, it tends to be the weaker credits that separate the stronger credits separate from the weaker. So there's a number of things that can go wrong when money starts to get allocated by assigning a cost to money that's more inconsistent with history. And that's a long way from where we are now in the market.
Are we about to have an inflation problem?
I don't know the answer to that, but I think one would have to, again, in the theme of contingency planning, one would have to expect that will be. But inflation by itself, again, for the financial markets, it's not the inflation that's, again, I mean, inflation is a problem by itself, but really that inflation will spur high interest rates. A lot of the kind of the cauldron of fire that I lived through that, I still have PTSD from, was of course 1994, where in something like 9 months, short-term interest rates, the Fed took short-term interest rates from 3% to 5.5%, and we're raising interest rates by 75 basis points. I believe it was between meetings. In other words, you can get behind the curve and then you have to catch up to it. Now, that doesn't mean I'm leaning now into doing those things to curtail inflation, because there's another side of it. What if this is not that real? And I will tell you, there's a lot of remedies in the world, painful as they are, for inflation. It's very hard to get rid of deflation. So if you had to err on one side or another, you would err on allowing a certain amount of inflation to take place and not want to get yourself into a kind of deflationary. See Japan for 25 years as a reference.
Seeing this from both sides, it sounds to me like you think the Fed is doing just about the right thing now.
I respect the Fed for standing up to a lot of pressure. And I think, again, deflation is a terrible thing. Inflation you could tolerate. I mean, it's bad, and we can go through all the things and how unevenly inflation affects different segments of the population. But it's easy to deal. Again, inflation, you go out and you buy things now because it's going to get more expensive. When you have deflationary expectations, you say, something, I'll wait for tomorrow. Tomorrow you wake up, you say, I'll wait another day because it's getting cheaper and easier, et cetera. And so that really is then you really are in the economic doldrums.
Would you reappoint Jay Powell as Fed chairman?
I would, based on what I see. And I'm telling you, shocking that I had such a good career as an advisor, and the president hasn't asked for my advice. But if he were to ask me my advice, I might point out that it would be very difficult. Here is a Republican, not merely acceptable to, but liked by a lot of members of the opposition, who probably is as dovish as a Democratic president with big infrastructure plans would like him to be. And so, like anybody to be. So, frankly, and I think he's a very good, strong guy and a great communicator. I'm very impressed by the way he's carried himself. Lloyd Blankfein has opinions on those issues, but I'm not sure that I should be on a soapbox on behalf of Goldman Sachs espousing those issues.
In London, in Sydney, in San Francisco.
9 a.m. in Beijing and Shanghai.
Good morning, everyone. Have a great evening.
To recap the headlines.
You do not want to miss this story.
How are you thinking about those dynamics?
provinciales van en contramano de lo que dicen la comunidad científica y los territorios que están en lucha. Han profundizado el extractivismo en Argentina con más agronegocio, con más transgénicos, con más agrotóxicos, con más proyectos megamineros, y ahora, como si fuese poco, han avanzado presentando un proyecto de ley que es la ley de hidrocarburos.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
In the early days of the pandemic, when New York was losing more than 800 lives every day, many people, including some business leaders, said the city was doomed. They were writing it off. How does New York's future look to you now?
Yeah, anybody who writes off New York is crazy. I mean, you know, the Roman Empire fell. It took 1,000 years, so I'm not saying anything has to last forever, but I see no reason to conclude that New York is going to surrender its centrality in finance and in terms of a place for people to engage and become acculturated into a number of professions. New York's also not a one industry town. You know, there's publishing and there's obviously finance and law and accounting,
media, fine art,
medical center, fine arts. You know, the city has to operate, and so it has to be done in a way and fairly, and people have to have housing, and not just people who, the wealthiest, and incorporate by reference all the things that everybody is anguishing over, which needs to be sorted out. But I wouldn't necessarily bet against New York, but there's a cycle to things. I spend time away from New York now too. Again, I'm not going into an office. In fact, nobody's going into an office every day, but pretty soon we will be.
Are you in favor of sending employees back to the office?
I'm in favor of leaning on people to get back into the office.
What about vaccine mandates? For or against?
You know, this is public health. It's not people say it's an individual freedom. You don't have the individual freedom to run a stoplight. You don't have the individual freedom to wave a loaded gun, which is like if you have COVID and you're breathing, in other people's faces. You have to stop at traffic lights, and you have to, guess what? If the country goes to war and you get drafted, you don't have the individual freedom to not go to war. There are certain things that we do as a collective, and it seems to me not infecting your neighbor is a public duty and not just an individual option.
Why haven't you moved to Florida with the rest of New York's billionaires?
I spend time in Florida. I've always had a place there, and I spend more there, but I'm not a Florida domiciliary. If I become one day because my lifestyle takes me down there, and I'm spending more time down there, then that'll happen organically. But I'm not manipulating my life to accommodate that. I have no reason to tell you why I'm not doing it. I'd need a reason to do it.
Well, most people do it for tax reasons, or they appear to do it for tax reasons.
Well, I'm not there yet. But if I get there, forget I said that.
What happens to New York City if its tax base, or at least a good part of its tax base, keeps decamping for Palm Beach and Miami?
Look, I said I was optimistic about New York. I think it's real. I think that the official sector have to take that into account and not be so cavalier. I do think that that there are a lot of reasons to be in New York, and some of those reasons overcome the extra cost, but not for everybody. And if the costs continue to rise, and it continues to be more difficult, then the decision point and the tipping point will occur at a different place. It is better for your business. It's better for your company. It's better for the young people who need to be apprenticed and acculturated to have that kind of mentorship that only comes from connection.
CEOs in this country have become more outspoken in the 3 years since you stepped down. Coca-Cola, for example, and Delta condemned the Georgia law on voter access, and Major League Baseball moved the All-Star game, from Atlanta to Denver. And what I'd like to know from you is where you think corporate America belongs in these constitutional debates over gun control, abortion, or voting rights.
It's very hard to resist, and if I were CEOing today, I'd work harder to resist it. I think...
Is that to say you think they shouldn't be saying these things and doing these things?
Again, I think a CEO is somewhat the champion of his people. And so, and their ability to do their jobs. So I was very out front on marriage equality and LGBT issues, because as a champion of the people who worked at Goldman Sachs, I wanted LGBT community in Goldman Sachs to be able to move from New York to another state, bring their partners with them, get medical insurance, which previously had only been available to spouses, and all those things, or the immigration. We were in a situation where immigrants who were born there and couldn't come in and work in the United States, or couldn't. So you took positions on that, but voting, I'm not sure voting rights falls into that category, or an intense divisive issue in this country. Abortion rights. Lloyd Blankfein has opinions on those issues. But I'm not sure that I should be on a soapbox on behalf of Goldman Sachs espousing those issues, my view of those issues.
Many of these debates are part of a broader movement. Do you believe in stakeholder capitalism?
Well, I believe that if you're running a company and you run afoul of people who have an interest in your company, you want them on your side. And if you don't have them on your side, that's going to cost your shareholders dearly. I think you want to get on the good side of all your, and stay on the good side of all your stakeholders, so you can deliver successful business to your shareholders.
The discussion is getting complicated.
I think it's very hard to stay out of harm's way in this kind of world where someone shoves a microphone in your face and says, here's good and evil. Are you on the side of good or on the side of evil?
It's not always reactive. I would point to Larry Fink, the CEO of BlackRock. He has very publicly defined the responsibility of asset managers as going beyond investment returns and including ESG factors such as climate change, right?
Again, I think you have to have a good relationship with your, people who are shareholders. He's one of them. Whether if I were in his position, I wouldn't be pushing my view of these issues as if, again, I think that's sometimes that borders on sanctimony.
You think he's being sanctimonious?
I think I think when you again, I don't know specific. You'd have to say specific things I can't think of. And he's a great guy, and I'm telling you, we all want to be on the right side of the climate issue. It's very important, and it's the future, and you can make this again a good and evil. But how much money should one? But there are different ways of doing it, and sometimes people do inexpedient, are driven to do inexpedient and non-commercial things, because you have to check every box in that space. And it doesn't always make sense to me, even though I know we need to do a lot in that direction and get on it. But you end up sometimes in a wacko situation where you're telling everybody that you're not going to invest in fossil fuels, which would be a great thing to do if we already had the alternative to fossil fuels. But given that we don't, we may find ourselves in a situation where the oil price is spiking and spiking and spiking, and there's no investment made because the firms that would be, aren't getting capital and are scared to expend capital in that space.
Lloyd, it's been more than a decade since Rolling Stone infamously described Goldman Sachs as a great vampire squid. And back then, rightly or wrongly, the firm was hated, and it was widely seen as the epitome.
Well, not everybody hated us, given that our market shares were the #1 firm across a lot of all the metrics. So we got a lot of bad press.
People saw the firm as the epitome of greed run amok. Again, rightly or wrongly. What I want to know is, what did you learn from that experience?
It was a populist moment. We were caught up on those things. In hindsight, a lot of the behavior look bad, and a lot of the paper might have been bad. It was, again, there was bubble elements to it. I'll tell you what I did, learn. So I learn, be on the right side of everything is one thing I learned, but that's not possible. If I did take away something as a CEO, up until that point, Goldman Sachs spent a lot of its public relation muscles in keeping our name out of the paper. Prior to that, I very rarely went on television, gave interviews. My predecessors didn't do very much of that. We always, the ethic was put your clients first, let them take it. You don't belong in the forefront. As a result of that, there was always for Goldman, and preceded my tenure, this mystique about Goldman, again, the last private partnership, et cetera, a mystique, the people had done well. Government Sachs, so many people from Goldman Sachs went into the government, as you pointed out earlier. That mystique became a little bit of an eye roll, and we did not do very well in the reputational. And in the vacuum, in Goldman not defining itself, people defined us for us.
You were CEO through the financial crisis and the aftermath. It included grillings in Washington. There was lots of regulation that followed. Are there parallels in that, or with that, in what the tech industry is going through now?
The country naturally and correctly abhors the concentration of power, especially economic power. And certainly Congress is elected, and they reflect. They are the outcome of democracy, and if you're viewed as more, if you thumb your nose at the elected representatives or the people in general, or you act in a way which shows you can afford to be aloof from public opinion, the culture of the country doesn't like that, and elected officials, again, appropriately, I'm not saying this as a criticism, don't really like that, and all of a sudden people will take you down a peg, or 2 or 5. Looking through it from a macro point of view, you don't want to let these pods of high concentration of economic power and influence get into place. So I'd always thought that the tech industry was kind of, in some ways, like financial services on steroids in some way, because they're very, very powerful, very concentrated. And they control, to some extent, control may be too strong, but they contribute a lot to the means of discussion and public debate. So if you're talking about the marketplace of ideas, we'll sort things out because everybody will hear everything and everyone can decide. Turns out that's not the case. People don't hear everything, and people are getting isolated in their little bubbles. So I wasn't sure what the approach would be for tech. It could be national security. It could be right to privacy. It could be antitrust.
You sound, for somebody who used to run a bank, pretty constructive about crypto.
I'm open to it.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
This week on Bloomberg Television and Radio.
We are on the verge of a disaster.
Join us live from Glasgow for coverage of the COP26 Climate Change Conference.
People are beginning to build some momentum, I think. The question is, will it be enough?
We'll speak with global leaders, keep you up to date on progress and setbacks, and analyze what it all means to you.
We're going to need to see some real action.
COP26, the UN Climate Change Conference, this week on Bloomberg Television and Radio.
While you were still running the place, Goldman dipped its toe, let's say, into crypto, clearing Bitcoin futures and exploring custody. Were you supportive or reluctant regarding crypto at the time?
I just took note of the fact that a lot of bright people think it has a bright future. I'm telling you, I have my whole foot and 4 toes into the old world, and it's not something that I gravitate to, and I can think of a lot of reasons why it won't work. But I remember when they were auctioning off Spectrum for cell phones, and say, well, why would anyone need a cell phone? All you do is you pull up to, you drive in your car, pull up to a phone booth, and dial a phone. Who would carry that clunky thing? And, the point is, there are a lot of things in this world that have worked out awfully well. And the success of crypto may turn out to be one, even though I could see huge disadvantage. We could talk about a medium of exchange that fluctuates so wildly, and something is safety, and yet you can hack it and you can never find. There's a lot of things that are obvious. People talk about the blockchain, but there's limits to the technology, how many things you could process. There's a lot of things that may be overcome. But one of the things where I think governments will be very hostile to it is in this. Look, I lived with the requirements of anti-money laundering rules. I think the official sector wants to know who's getting paid. We want them to know who's getting paid. That was the whole outcome of 9/11 and the World Trade Center bombers. In crypto, you can't tell whether you're paying the North Koreans or Al Qaeda. So you have to add that in. Other issues come. Do you really want a competitor for the dollar? There's a million reasons why not. And yet, despite the rhetoric, despite the crushing of the commentary, despite the existence, everything I'm saying is not new. It's out there. It doesn't go away. And so we didn't speculate in it. We didn't adopt it. And if our clients want to do it, we want to be in a position to help them do it. And in the back of my mind, this one may be one of the 1,000 things that I never in a million years thought would work, and it may work.
You sound, for somebody who used to run a bank, pretty constructive about crypto.
I'm open to it. Look, I ran a bank and I ran risk. And you can't be closed. You have to separate fact from opinion. Nobody knows. Nobody knows the future. There's all sorts of things. There's a lot of things that move in directions that I couldn't and wouldn't have anticipated, and no one else would have either. So to just come out and say that a market that's already in excess of $2 trillion, that faces all these regulatory headwinds, that a lot of people really don't like and would enjoy seeing crushed, somehow managed, it doesn't, every day it doesn't look like it's flourishing, but on no data has it recently looked like it's dying.
Do you own any? Do you own any crypto?
No.
You know Gary Gensler, the SEC chairman, well. He was a partner at Goldman Sachs.
Well, I used to know him well, but sure. I don't know him nearly as well the last 20 or so years.
And knowing what you know about him.
He's a smart guy. I hear him on TV. I follow him. I think nobody is going to outwork him or be better informed than he is about the things about which he has authority.
Do you have any idea what he might do about crypto regulation? Any thoughts on where he might go with it?
Now, it used to be little. Now, again, over $2 trillion in it. And you can't have, that can't be the only thing where it's buyer beware, where it's the most Wild West cowboy and, something goes missing, nobody knows who took it. And so there has to be regulation. And I think the other point he makes is absolutely correct. the participants in that market should want sensible regulation because it will legitimize the market and provide safety nets so even, old fogies who have no interest in this stuff would feel, maybe I'll take a little bit of a stab in and feel more comfortable at it because there's some regulation and there's some background, and the people are being held, people who are platforms in this space are actually being held to the performance they're claiming to have.
It was at Goldman, actually, that what I might discuss anymore, the 100-hour weeks.
Yeah, I don't know much about that.
The demeaning treatment by imperious bosses.
The hell with them.
Seriously, though, had it happened on your watch, how would you have handled it?
It happened on my watch. It happened on my watch 100 times. It happened on my predecessor's watch. Everybody is grousing and complaining in every industry. The acculturation process into a real profession where there's real content is not an easy thing. There's language gaps. You have to learn presentation skills, how to organize the things that 5 years later in your career you'll be able to breeze through with a glance take a week to go through. I remember I went to law school. My first week, it took me a week to read a case to figure out what was in it that really mattered. By my second year, I'm as fast as I could flip the pages, I could see what in an accounting firm. There's going to be stress and time that you're going to have to put it, and something, I think now this will sound like ageism, maybe it is, but I think it's age appropriate for people at the outset of their careers to kill themselves, and you get rewarded for it because there's no other way of learning the language, learning the thought pattern, learning to recognize things with a glance instead of poring over for a week. And there's no substitute across the board.
So what changed? Because if you felt that way, and Hank Paulson before you felt that way.
Well, I don't attribute any, Hank is a saint, so I don't know, there's nothing that he's done wrong.
And all the other CEOs on Wall Street felt that way and stood their ground. What happened? Something changed because they all.
What happened?
They gave them 35% raise.
Well, they should get a raise. I'm not saying nothing. What I said is that you shouldn't pay people. Wall Street is having the same problem as people who are working in restaurants. Restaurants are finding it hard to get people, and people aren't mowing lawns, and people aren't.
So this was simply a supply and demand question. If you want the talent, you have to pay for it.
If you want the talent, you have to pay for it, and other people are willing to pay for it. And I don't think it was a matter of altruism. I think, big firms. Look, one of the reasons why people go to Goldman is for the training, because that's an imprimatur on somebody's resume.
What's the woulda, coulda, shoulda that you do actually regret not doing?
Enjoy being a senator with all this pressure on you? Is this fun, or is it not that much fun?
My dad always said, if you can say no with a tear in your eye, you might be okay. And I've been crying a lot lately.
Do you see Deutsche Bank ready to pay more and pay out more in terms of bonuses too for staff to have that strong talent that I'm sure you want?
Well, look, it's a war for talent. It has been, in other cycles before. It is now. We're finding that we're competitive in that war for talent.
I would have to imagine that as the former CEO, you look back on your career and you revisit many of the decisions that you made. Some of them went well, some of them went poorly.
I prefer to think about the good ones, but I find myself drawn to the poor ones.
So I want to ask about this one. Goldman had a chance when you were the CEO to buy iShares, the ETF business, and it was ultimately acquired by BlackRock, and it's become a $3 trillion behemoth. How come you weren't bidding more aggressively at the time?
You know, of the price that was paid, it was almost entirely goodwill. And so to take dollars and turn it into goodwill, what's the value of goodwill in a financial crisis when everybody's worried about your durability and your solvency? So in hindsight, even in hindsight, I don't know what we would have been in a position to do, because the nature of the big balance sheet nature of an investment bank that has to make big commitments and take risk positions and be the other side of what your clients want to do.
So if it wasn't iShares, but what's the woulda, coulda, shoulda that you do actually regret not doing?
I think I'm retired. I think
still a big shareholder.
So in my tenure, I think looking back at it, I'm a client of Goldman Sachs' high net worth business. I think it's fabulous and it's a jewel. I think investing and enlarging that business at a faster clip than was accomplished in my tenure would have been a good thing to do. But you're asking me with the benefit of hindsight, I get a little confused. Obviously, with the benefit of hindsight, it would have been good to have a big ETF business and that. But again, I'm not sure accomplishing that without changing the nature of the firm and getting more, I'm not sure that would have made us as durable as we were and as successfully to navigate the financial crisis. But in hindsight, that certainly was a good, and I give credit to the people who saw that, better than I saw it.
Should you have gone into retail brokerage?
I think that that's a good business for other people. Again, you have to know a little bit who you are. I mean, you could be everything, and then you're not necessarily anything. And people identify us, and we identify ourselves historically with the wholesale market, with the most successful companies, and the biggest. If there's a big deal, I expect Goldman Sachs to be in it. You probably expect Goldman Sachs to be in it. And that was our brand, and that was our reputation, and that's kind of who we were. And I kind of like that.
Jamie Dimon was asked recently why he's still CEO of JP Morgan after almost 16 years. You may have seen the interview. In it, he said, and I thought that this was revealing. I really did. He said that he needs a purpose in life, and his purpose is JP Morgan. Does that answer resonate with you at all?
When things are going well, you don't want to leave, because it's the greatest thing in the world. When things are going badly, you can't leave. And so I always knew I had to have the discipline to leave when I didn't want to leave, i.e. when things were going well, because otherwise you get carried out. And so that was a bit my calculation. I wasn't so much done with life or ran out of gas or anything like that. It was long enough, and it seemed like everything, had gone through a lot of, stuff, and things were, things felt okay to me, and I thought it was a good time to transfer the flag.
was just finishing what you were saying, Tom. November 3rd is when the decision is. Just in case people got confused, I will. Just one more story, Tom.
Yeah, thank God for that.
We're at 1:37 right now.
Wrap it
into
up.
weakness. Is this where they play the music and the Academy Awards? Is this it? Do I thank my mum again? Are you in charge of this?
Is she the only one?
Kill the music. You know who's in charge here.
This is a market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
This is my kitchen table and also my filing system. Over much of the past 3 decades, I've been an investor. The highest calling of mankind, I've often thought, was private equity. And then I started interviewing.
While I watch your interviews, I know how to do some interviewing.
I've learned in doing my interviews how leaders make it to the top.
I asked him how much he wanted. He said $250. I said, fine. I didn't negotiate with him, and I did no due diligence.
I have something I'd like to sell, and how they stay there. You don't feel inadequate now because being only the second wealthiest man in the world, is that right? One of the most successful investors and entrepreneurs in Silicon Valley is Reid Hoffman. As an entrepreneur, he helped to build PayPal, and he started LinkedIn. As an investor, he's been an early investor in Facebook and Airbnb, and now he's a partner in one of the leading venture firms in Silicon Valley. I had a chance to find out what the unique qualities it takes to be a great investor and a great entrepreneur in my conversation with Reid Hoffman. The venture capital world today seems like it can never get any better. Everybody seems to be making money. The values are high, but the returns are very high. Can it get any better than this? And are you worried about this being a bubble, not unlike what we had in the tech bubble burst in 1999 and 2000?
Well, you're always worried about the markets getting overinflated. Amount of stimulus, everything else is part of making this happen. And so I do think that there is some risk within the general market of this. Now, that being said, technology is accelerating the transformation of all industries. There's what artificial intelligence can do to all industries. There's obviously, that's the leading edge of software. There's things happening with AR and VR. There's things happening with crypto and fintech. And so all of this area, I think, is very much accelerating in the future. And so I think that's part of the reason why the venture industry has been so good, is because technology is important in redefining many key industries.
Hey, now Silicon Valley is not the only place in the United States where there are technology investments, but it seems like the Silicon Valley companies seem to be the most valuable, and that's where the most activity is occurring. Is there something about Silicon Valley that makes it unique and better than other areas of interested in technology in the United States?
There is. Silicon Valley itself has a number of overlapping network effects. It has a network effect of essentially being the hub by which a lot of English-speaking entrepreneurs from around the world come to start their software businesses or key technology businesses. There's the hub for capital and the knowledge and investing that goes into it. There's a hub of talent for people growing these companies. As part of the reason I wrote this book, Blitzscaling, for how do you build technology companies at a global scale, lightning fast, and the talent. There's network effects of learning and of sharing of information, and it's part of the reason why Silicon Valley, which has the whole Bay Area has like 3.5 million people tops. That's not the tech industry, and why half of the NASDAQ emerges out of Silicon Valley is for those kinds of reasons. And those network effects are what make Silicon Valley great.
What about around the world? Is China likely to catch up and pass Silicon Valley as a leader of technology?
I think it's one of the greatest concerns that Silicon Valley knowledgeable people have, because China is amazing. It has huge amounts of tech talent. Everyone's acting like an immigrant, with hunger. Like large companies have this policy 996, 9 a.m. to 9 p.m. 6 days a week. You're discoverable at your desk, and that's kind of like tens of thousands of people in technology companies, and they're doing a lot of innovation. There's things that we learn from China, and so I think that China is going to have one very strong creation of the technological future. It's one of the reasons why in blitzscaling we call it the land of blitzscaling. I think Silicon Valley has some edges too, but I think it's very much of a game-on circumstance.
Now, some people would say that the technology world in the United States is dominated by just a limited number of companies: Google, Facebook, Apple, Netflix, Microsoft. I'm sure you're familiar with all this. Do you think that the United States is dominated by too few technology companies, and something should be done to kind of weaken their power, or do you think it's okay as it is?
Well, what I think that we're heading to is we're going from 5 massive tech companies to 10. I think we're already naturally heading in that direction. You can see it with things like Netflix and Salesforce and all of these other companies, which are continuing to also grow in strength and create a breadth of additional global, very strong technology companies. And as perspective as an investor, when you go around and you ask what all the the venture capitalists, they're like, no, we're having more and more startups, more and more ability to create amazing new tech companies. So if anything, I think we're already naturally on that trajectory.
Do you think that large Chinese technology companies, Alibaba, Tencent, Baidu, ByteDance, and so forth, can have their technology become very dominant or important in the United States and around the world? And are we in a world now where we're competing with Chinese technology companies for market share outside of the United States and China?
So I think we're already in that world. I think that if you look at things that Alibaba is doing in terms of spreading the Alipay and everything else into South America, into Africa, I think that the notion of the technological platforms of the future are in deep, there's a fast moving competition between companies in Silicon Valley and companies in China. And I think that's part of which systems will be the systems that the world operates in is, I think, in deep competition. And that being said, I think we're already seeing Chinese platform companies beginning to make strong headroads into the U.S. ByteDance and TikTok is an obvious one, but I think you already see it in also drone manufacturer and DJI. There's a whole bunch that are already getting massive global relevance, and you can see it already.
And let's talk about the future. Some things that people are interested in right now. One of them is cryptocurrencies. Are you a cryptocurrency aficionado or not?
I am. I actually, if you go to YouTube and search for Bitcoin rap battle, this is inspired by Alexander Hamilton the musical.
If this crypto system will be our salvation, it needs to be centralized. It needs regulation.
I ideated and then funded and produced a rap battle between Alexander Hamilton and Satoshi Nakamoto. And that's because I think there is a real role for cryptocurrencies in helping us evolve.
So do you invest in cryptocurrencies yourself?
I do.
Okay. What about transportation? Are you a big believer in autonomous vehicles?
I am. I've invested in Aurora and Neuro because actually, in fact, it's literally a question of when, not if, and how soon for when we have autonomous vehicles. It'll make all of our societies better. It will save, tens to hundreds of thousands of lives. It will enable a huge amounts of increase in productivity. And so I think it's a great thing that we should be accelerating to as societies.
Have you been in one of these cars where you were not the driver and you feel safe?
I do, and I do. Look, I think part of the thing that all of them, not just Aurora, not just Neuro, but all of them have safety is the very first thing. So when I've been in these cars where there is nobody in the driver's seat, it's been good and fine.
Do you wear a crash helmet when you're in those cars, or
no?
No, you don't. Okay. What about flying taxis? Is that something in our future?
It is. As you know, I also helped bring Joby public by SPAC, and it's moved the transport grid from 2D to 3D, redefine space in cities, make commutes much less onerous, be reliable in getting to the airport on time, or be able to live, kind of more distantly remote, and then be able to come into the cities. And so I think the Jetsons is now no longer science fiction, but en route to science fact.
What about space? Do you invest in outer space related investments?
Not as intensely as some of my friends like Elon, who obviously are in it. I put some money into SpaceX. That's more because, you know, Elon and this amazing transformation of the world. But it's obviously an important area. I've kind of ended up in it sometimes just by who I know.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
So let's talk about how you became an investor and an entrepreneur. You were going to be an academic, and then I guess on a road to Damascus kind of epiphany, you said, I'm not going to be an academic, I'm going to be something more important than an academic, I'm going to be an investor.
Well, actually, I didn't start with investor. It started with a product creator. I wasn't even necessarily starting with entrepreneur. It was, how do we think and speak better? How do we make ourselves better as individuals and as a group? Well, actually, this medium of software, this medium of constructing new products, it was kind of like I was just beginning to get that lens of what does the internet mean and how do we all work together and play together and live together using the internet to redefine our space and redefine our networks in order to be better. And I should go create that.
Well, as you were starting this career, you were invited to join a company that was called PayPal. And PayPal turned out to be a gigantic success, later sold to eBay. What was your job at PayPal?
Well, so when Peter Thiel and Max Levchin started PayPal, they each invited their friend who most understood and had entrepreneurial experience to be on the board. So that was me for Peter. And then after about a year of being on the board, I was thinking about going and starting another company. And Peter said, no, come join PayPal full time and help us because, you know, you've been helping us so much on the board and you understand this stuff. And we have so much to do because PayPal was an early blitzscaler. Its theory was it was going to be a bank, and that was not a workable theory. So we had a great customer acquisition engine, but how do you redefine the payments OS was something that was all in front of it, even as it was exponentiating its burn rate. So I joined PayPal full-time, stepping off the board.
All right, so PayPal was ultimately sold, as I mentioned, to eBay for about $1.5 billion or so. You got your share of the profits. You then became an angel investor. For those who don't know what an angel investor is as opposed to a devil investor, what is an angel investor?
Well, sometimes there may be investors that entrepreneurs think are devil investors, although that's usually more post-fact. Angel investors are individuals, usually with some expertise in this area or some knowledge of the entrepreneur, that tend to invest of the earliest stages of a company. Frequently, well, it's an idea on the back of a napkin or an entrepreneur just thinking about doing something, although that has all, like all investment, has professionally scaled and does so kind of individually. Not with a firm, the resources and assets of a firm, the platform, the network that a firm brings. And so that was what I started doing, mostly just because I was interested in other folks who were building these great projects that I wanted to help out with and participate in.
Hey, when you started doing that, you did it relatively prolifically, and you became known as maybe the most active and maybe the most successful angel investor in Silicon Valley. One of the companies I think you invested in, was that Facebook?
Yes.
So what did you see in the young Mark Zuckerberg? Did you say this is going to be one of the great companies in the world, or you just said, I'll take a chance?
So Facebook had already successfully launched a product that when it opened up a campus, because when I did the investment, it was strictly only a kind of a university campus, network, not the whole world. But when it opened up a campus, in 6 weeks, 80% of the campus was using it 6 times or more per day. And so you could just look at the usage curve and go, this is interesting. The person who's created this is really interesting. And even though back then Mark was very quiet, so had a tendency to not talk very much, long pauses, minutes long pauses in the conversation where you're like, is this conversation over? You could see that he was very smart, and you could see what was the trajectory that Facebook was on was really interesting.
So let's talk about this. You're an angel investor. You're doing pretty well. People are coming to you all the time with deals, and while you might miss one or two, basically you're doing quite well. Why did you join a firm called Greylock, an excellent venture capital firm, but why did you need to be joining a venture capital firm? You're already your own venture capitalist. You had enough money to start your own firm. Why would you join Greylock?
So not surprising for the guy who co-founded LinkedIn. I think in networks, and I think in networks as platforms. And one of the things that I think those small number of very elite venture capital firms within Silicon Valley and other places do is create a network. And I was originally thinking about building my own, and then David Z and Anil Busri, who were then both general partners at Greylock, came to me and said, "Hey, we're in the process of moving the firm from Boston to Silicon Valley. It's kind of a rebirth of the firm, which has this great set of investors and pedigree and culture and learnings and all these things that will be very helpful, but also this idea of network amplifier for venture capital. We love it. We'd love to do it with you." And I was like, "Wow, these are people. I would be delighted to be partners with these folks. So let's build the firm here."
Now, when you were starting at Greylock, even though you had already had a good career as a venture investor and angel investor, I think one of the legends of Silicon Valley is the deal you wanted to do was Airbnb. And the senior partner at your firm said, "Look, this is a terrible deal. It's going nowhere." So were you intimidated by that because you had a lot of experience, and how did you push that through?
There's even more drama than your question suggests, because the senior partner is David Z, who is who's an amazing general partner, was my board member from Greylock at LinkedIn, is the reason I'm at Greylock. And so I bring in Airbnb. It's my first deal that I'm bringing into the partnership. And David, who I'm super close to, who I have deepest respect for, has returned billions of dollars to the fund, looks at me and says, "Well, every VC has a deal that they can learn from and fail from, and Airbnb can be yours." And so I was like, "Oh, David's super smart." And so ultimately I kind of said, "Well, look, I have to have the conviction. This is a portfolio. I'm going to, he gave me the hunting license, the permission to go do the deal. So I went and did the deal." Now, to David's credit, 6 months later, the numbers hadn't changed at all. He came back to me and said, "I thought about it a lot. I think you were right. I was wrong. What did you see that I didn't see?" And I said, "Well, all of the risk factors that you saw were correct. I just realized that if you navigated through the risk factors, which I could see as able to do, then you would end up with a redefining company of an industry. It would be, it transforms the entire industry." And that's the thing I saw.
You had some time, I don't know where you got the time from, to start a little company called LinkedIn.
The goal was building something that enabled every individual professional to transform their career by collaborating within a network.
reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Engine number one was able to do on the Exxon fight. It opened a lot of people's eyes to, I guess, the power that smaller investors can have. And I'm curious as to how other people can sort of look at what you did and use that is either a template or maybe just some sort of guide as to how they can sort of approach their relationships with other companies.
We founded the company in Engine Number One on the idea that we take the data, not ratings and rankings of the ESG of the past, but we actually take the environmental, the climate, the social, worker data, and we simply use it to look at the valuation of companies and look at it over a long period of time. And so if you think about it that way, you own these companies. Everybody that owns the company, whether you're a big institutional investor or you're a small retail investor, you own the company. You have a voice, you have a vote every year.
Yeah.
And so our approach is to use the vote and engage with these companies over time.
But that's always been the case, I mean, at least in theory.
Gasoline prices are high because it's mixed with ethanol that went tenfold. Gasoline prices are high because there is low stocks in the U.S.
So in addition to venture investing, you had some time, I don't know where you got the time from, to start a little company called LinkedIn. How did you have time to start a company called LinkedIn while you're a partner in a venture firm?
Well, actually, I started it much earlier than Greylock. That's actually how I met Greylock, because David Z led my Series B. So I was doing angel investing while I was the founding CEO and co-founder of LinkedIn. But I didn't start venture investing until after I'd hired Jeff Weiner to be the CEO of LinkedIn.
And LinkedIn ultimately was sold to Microsoft for roughly $26 billion or something like that. Did you ever anticipate something like that when you started the company or helped to start the company?
So one of the things to think about when you're strategizing, and it's like my first book, The Startup View, has this framework called ABZ planning, which is part of it, is to think about the spread of outcomes. Like what's the great possible outcome? What's the worst outcome? What are the intermediate outcomes? What are the things that change the landscape of it? So I always knew that LinkedIn could be a network as a platform that would be transformative. And I also knew that it was the kind of thing that most aligned with Microsoft's mission. So did that mean that I knew that Microsoft was going to end up buying it for its kind of the largest acquisition in its history? Or, and the answer is no. I thought it was a possibility. It was an outcome. It wasn't the goal. The goal was building something that enabled every individual professional to transform their career by collaborating within a network.
All right, when you sold the company to Microsoft, you went on the board of Microsoft.
Yes.
And let me ask you about that. Microsoft was a technology company that came out of nowhere, became a dominant software company. Many people thought it would go south as it was, getting older and older. It transformed itself when Satya Nadella became the CEO. Were you shocked and surprised at how the company has become one of the most valuable companies in the world again?
No, for a number of reasons. One is Microsoft has always had an enormous amount of talent throughout the whole company. The technology depth, Microsoft, has actually created a whole range of products within not just the commercial side, but also Microsoft Research. And so there's always this raw amount of talent. And then obviously having some key franchises like Office and Windows and other kinds of things, and being willing to be bold in creation of Xbox and the gaming franchise. Now, that being said, I'd say that the thing that Satya brought back with vigor to the company was a focus on earning the ability to build the next generation of products, starting with his own background in Azure, but also kind of transforming across the company we are only one company in this universe, and we are doing our absolute best to surprise and delight our customers.
So let's talk about the different skill sets. To be an investor, you need a certain skill set. What is that skill set, and what is a skill set, and how is it different to be an entrepreneur?
So, well, I'll start with an entrepreneur because I think it's a little easier, which is, the game is hard, but the definition is easier, which is you have a vision for where the world is moving towards, where you can help build it towards. Frequently in the case, a new technology or a market shift or something that gives you that kind of market opportunity. You can assemble through your network the assets, not just capital, but talent, the ability to build the new product or service. And you're driven by kind of the cadence of a complete focus on how do you navigate that path, which can include pivoting, includes risk management, and a bunch of other things. But it's that build of building something from nothing, and then in kind of blitzscaling, getting it really large very fast. As an investor, what you're looking at is judging entrepreneurial talent in that same kind of circumstance of, can this set of people, can she or he, sometimes better to have 2 or 3 founders, do that, run this race. And the key thing that's a difference between being the entrepreneur, where it's kind of the all-in focus, this is the only thing I'm doing, and an investor, is that you're making the judge. You're not running the race as the investor. The founders, the entrepreneurs, they are running the race. You're helping as much as you can, but you have to judge, can they do that? And then can you help them as best you can get there? But it's the key difference in skill.
So to make people feel good who aren't as successful as investors as you are, do you have some failures you can tell us about where you made a terrible mistake, you lost all your money, just to make the rest of us feel good?
It depends on, do we have days? I can go through the list. And actually, by the way, the interesting question about the analysis of here is not as much of the companies that you invested in and went to zero. There's a large list of those companies that did that. The real thing is the companies that you missed. So like missing Twitter, missing Snapchat, missing Pinterest. Those are much worse outcomes than you put in, $100,000 or $1 million or $10 million in this other company that went to zero.
So final question, if somebody said, I want to be the next Reid Hoffman, person who's starting companies, investing in companies, doing good things for public policy, what would you say is the best training ground to do that, and how should somebody prepare to be the next Reid Hoffman?
Well, I'm still young enough that I'm still hoping to be the next Reid Hoffman myself. But that being said, there's a number of people who are like this within Silicon Valley who bring an entrepreneur's mindset, an entrepreneurial success, together with an investing mindset, and play a central role in the network. And many of these folks are folks that I work with. I could literally spend another hour listing names. Ali Partovi at Neo, other areas by which we collaborate with these folks. And so I think there's a lot of people out there who are all going to be the next themselves, with this amazing kind of track record and luck.
energy crisis, there's a lack of drivers. Is there anything that you need to ask authorities to do better, or that your clients want the UK to do better?
I think we're at a moment in time where we're coming out of the pandemic and there are a handful of things going on. I think all over the world there are labor issues that are really a reflection of this transition out of the pandemic. There are supply chain issues. Some of this stuff is transitory. There are some secular trends that we have to watch closely, but I think we're adjusting.
When you look at the UK and of course some of these green investments that the UK and the City of London particularly has been really trying to pitch, you've been extremely involved in carbon offsetting. Can London really spearhead that movement?
Well, I think it's important that governments around the world partner with the private sector to try to get capital directed toward innovation in a way that we can accelerate the climate transition. And I want to emphasize it's clearly a transition.
I think it's still a pretty good time for real estate. Texas and Florida are well positioned. You should stay away from buggy whip businesses.
John Gray went from aspiring journalist to become one of the top real estate investors in the world.
When I met my wife in English class, I showed up wearing a suit and tie. Everyone else was in Birkenstocks. It was clear I'd made a decision which path I was on.
John joined Blackstone in 1992 and was the second employee in its real estate division.
I say to my kids all the time, luck is a core competency.
But it wasn't all luck.
I've had the opportunity to know John and work with John since I think his second day at Blackstone, when he had just gotten, out of Penn. While I think to a degree luck is, involved in anybody's success, I think with John, it's a gross overstatement. I think it is just simply raw talent.
By 2005, John was running Blackstone's real estate unit and spent the next 13 years building it into a behemoth with about $119 billion of assets.
I think he has a very unique ability to combine tremendous amount of vision and understanding trends, generally ahead of a lot of other people, and conviction. And he turns that conviction, unlike few people I have seen, into very bold, big moves that have generally paid off.
What put John on the map was Blackstone's $26 billion deal to buy Hilton on the eve of the financial crisis.
So there were a lot of things going really, really wrong. I'd say John's leadership throughout was what I would describe as sort of a steady hand on the wheel.
The Hilton deal ultimately became one of the most successful private equity investments of all time, reaping more than $14 billion in profits and catapulting John to the number 2 job at Blackstone.
John's sort of the natural. He's just got it all.
Seems that journalism's loss has become private equity's gain. When you were growing up in the Chicago area, did you say, one day I want to be the greatest real estate investor in the world?
No. I got here as an accident. I had grown up in suburban Chicago. I'd never really been to the East Coast prior to going to college. And when I got to college, I decided that I really wanted to be an English major. I wanted to be a journalist, is what I thought. I wrote for the Daily Pennsylvanian. And about a year into school, I realized a bunch of my friends, fraternity brothers, liked business. They were in Wharton. And I owned a few stocks. I liked numbers, so I decided to get a dual degree. And that was really important for me because my senior year in college, I met a young woman who was an English major also. And a few weeks later, I got a job working for a small investment and advisory firm. And that was about 30 years ago. And that was Blackstone, and that was my wife, Mindy. So that really set me off. And so I went from Philadelphia, I came to New York, and I started at Blackstone in the private equity area and in the M&A area. And I was mostly running numbers, doing pitch books for clients, and ordering dinner. I had to make sure the associates got their food by 7 o'clock. And about a year into things, the real estate market had collapsed. And the visionary founders of Blackstone, Steve Schwarzman and Pete Peterson, said, look, real estate is a place we should go. They found a guy in Chicago, John Schreiber, a terrifically talented investor, and they formed a real estate business, and they had no people. I had been helping them draft the private placement memorandum for the first real estate fund, and they said, you seem like a reasonable person. Do you want to move over and join this group? And I talked to Mindy, I talked to my parents, and I came back and said yes. And that's how I ended up in the real estate business.
Okay, so what did you all do in the beginning? Did you have money to invest? Because you didn't have a fund, I presume, in real estate. So what did you do for money?
We had to raise the money. And we also just did very little deals to begin. So the first deal I worked on was a shopping center in Chesapeake, Virginia, the Great Bridge Shopping Center. It was a $6 million transaction. We borrowed $4 million, so it was a $2 million equity check. And you would have thought I was buying the island of Manhattan. I mean, I was down there for 3 weeks. I met every tenant. I was counting the car traffic. I was learning the business. And it was an amazing experience because I was the chief bottle washer. I was the waiter. I was the maitre d', because we were this tiny little business, and I was learning it firsthand.
Okay, so let's talk about 2 deals that you did eventually that became 2 of the best known deals in the history of U.S. real estate, I would say. The first is EOP, built by Sam Zell. Can you explain what that deal was and why it was such a risky deal and why it turned out to be for you a very good deal?
I stumbled on the public real estate markets where there were companies that owned real estate that were trading well below where these buildings traded out individually. And then we said there's this new commercial mortgage-backed securities debt, which is much lower cost than leveraged loans and high yield that you typically use in a buyout. And we convinced the banks to let us use that to go buy real estate companies. And beginning in late 03 through 07, I think we did 12 of these deals where we started buying these big public real estate companies. We used the public CMBS debt. And then in many cases, we would sell off pieces. Think about it as a fruit basket. You'd sell the grapes to the people who wanted that and the bananas over here. And that's what Equity Office was all about. We bought the biggest collection of office buildings in the United States. And so it was like running a store where on the front end you're taking in the merchandise and the back end you're selling it. And so within 60 days, we ultimately won the auction. We sold almost 2/3 of the real estate. We paid down our debt. And we ended up owning really great real estate. One thing people don't focus on is we kept assets in California and New York and Boston. Had we kept suburban Chicago and Stamford, Connecticut, it would not have been so good. So at the end of the day, it was a wholesale to retail arbitrage, but the key was what we kept, and then we held it and ultimately tripled investor capital.
In the end, it turned out to be a great deal for you.
Yes.
Right? The people you sold the real estate to, it wasn't so good for them because the real estate market collapsed more or less when you completed the deal. So ultimately, did you ever buy some of that stuff back from the people you sold it to before?
We ended up buying some of it back, and a lot of those people are my friends. No one knew at the time the music was going to stop.
So let's talk about another deal you did that also turned out to be probably the most profitable buyout of all time. It's real estate related. Right before the market crashed in 07, 08, you bought the entire Hilton Hotel company. What was your thinking about buying Hilton Hotel? Was it a real estate play or a corporate play?
I'd say it was a bit of both. We did the transaction with our real estate private equity funds and our corporate private equity fund because Hilton owned great real estate like the Waldorf Astoria, the Hilton Hawaiian Village, but it also had this amazing management franchise business. And when we bought the company, it was similar to the Equity Office transaction in that we thought we were able to buy something because of the scale and because it was in the public markets more inexpensively than we could buying these assets individually. And we also believed that the multiple was reasonable. We were paying 13 or 14 times cash flow for what we thought was a great business. Our mistake, of course, was that our timing was terrible. We closed on the transaction at the end of 07. In less than a year, of course, Lehman would collapse, the global economy would be melting down, global travel would decline dramatically, this company's revenues would go down 20%, cash flow would go down 40%, and we marked our largest investment ever as a firm down by 71%. That was not a good feeling. But what I would tell you is we believe the decline was cyclical in nature. And so we invested $800 million more at the bottom. We stuck with the company. It started growing. There was a cyclical recovery. We ultimately took it public. We broke it into 3 different companies, a management franchise, timeshare, and real estate business. And we made $14 billion for our investors. So it ended well.
Well, when it wasn't looking so good, did you go home to your wife and say, you told me to go into real estate and maybe it wasn't such a good thing? You didn't say that?
You know, it's funny. In all seriousness, my wife and my children, that was really important. As you know, in a period of time when things are stressed, having people you can rely on and talk to and who still believe in you is really important. And it was hard because you felt terrible, you felt badly with your colleagues, with your investors, but we never lost faith. And really for me, that experience, that searing experience in Hilton, was probably the most important thing for me as an investor. Because what I learned was we bought at the worst time possible, and we ended up having the most successful deal of all time. And what that said is we had bought a really great business in what we call a great neighborhood. It had terrific tailwinds. People, global travel is a growth industry. These brands were super valuable. And so what it's led me to think is too often when we invest capital, we focus on, I'll call it the individual house, not am I in the right sector? Do I have those tailwinds? And in this case, this was a fundamentally great business, and we could afford to have paid too much and do it at the wrong time. But ultimately, with the right management team, the right financial support, we made a bunch of money. And that has really impacted everything I've done since then. I think this shortage in housing will become more acute, and so we continue to like it as a sector to invest in.
Call it the incredible shrinking office building. As more Americans work from home, demand for office space is plunging. The result? Big investors are putting their money into warehouses, data centers, and studios and other production spaces used for streaming. In January, Blackstone took a majority stake in dozens of warehouses, most of them in California and Seattle. The rise of online shopping has made warehouses and other logistics properties more valuable. Last month, Blackstone bought data center operator QTS Realty Trust for roughly $10 billion. The numbers tell the story. Office space in the U.S. made up 19% of Blackstone's portfolio in 2015. Now it's 4%. Hotels were 23% of the firm's portfolio in 2015. Now 6%. But logistics properties have surged from 9% in 2017 to 38% now. Let's talk about two different types of real estate. There's residential and there's commercial. So is residential less risky or more risky than commercial?
Well, if you talk about for-sale single-family housing, there's probably more risk in the sense that you're building something and you're selling it and it's a function of the market. If you're talking about rental housing, think about an apartment complex, that tends to be less risky because it's less cyclical. People don't give up their apartments when there's some volatility, but nothing like, say, office buildings or hotels. So I would say residential, rental real estate safer, less volatile. And then commercial real estate involves office buildings, warehouses, which has been the biggest theme for us over the last 10 years, hotels, shopping centers, senior living facilities, and all of them have different risk returns depending on geography.
Another way of looking at real estate are things that are already existing and things to be built. So is it riskier and higher reward to build something, or are you more in the category of trying to buy things that already exist?
We generally are in the business of trying to buy existing real estate at a discount. So we bought the Cosmopolitan hotel and casino in Las Vegas, and we bought it for less than half of what it had been built for because it was built during the financial crisis. So that to me is ideal. Occasionally we'll build things, but in general we like to try to get into real estate at a lower basis when it's already producing income. The problem with development is it's a bit like saying I'm going to IPO 3 years from now. When you show up to lease up your building, we could be in a different economic environment, and therefore you may not have tenants, you may not have revenue. So we've generally biased towards existing real estate.
Now, as a general rule of thumb, over the last 100, 200, 1,000 years, real estate prices generally go up, values increase generally. But why is it that sometimes real estate developers, you read about them going bankrupt? Is it because of leverage or because the values actually went down?
I'd say that the classic sin in real estate is you have long duration assets and people finance them short term. And so for developers who often rely on a lot of leverage, that can get them into trouble. The other thing that could impact real estate, particularly today, are changes in technology, the ways we live and work. So if you think about enclosed shopping malls, they were from really the post-war period until a decade ago, the best assets. A large shopping mall anchored by department stores, lots of retailers, food court, they grew value 5% a year unleveraged 40, 50 years because they were very hard. They were really fortresses. And what's happened, of course, is the internet showed up, e-commerce showed up, and that's really impacted those businesses, and we've seen sharp declines. But that happened over a long period of time. So it can be secular changes in the way we live and work, but the bigger thing generally, to your point, has been leverage.
Some people say that real estate is favorably taxed by the U.S. government. I assume that's because of depreciation and other kinds of things. But now one of the most favorable parts of the tax code for real estate has been something called a like-kind exchange, known as a 1031 exchange. The current President Biden, has proposed changing that. Will that affect real estate very much or not?
I think it'll affect individual investors who've owned assets for a long time, will harvest gains and then buy a new piece of real estate. For the institutional investors, it's less of an impact because we're selling, we're paying taxes. The way it may impact us is if there's less selling as a result. The same thing could happen if capital gains go up. You could see some individual owners of real estate be more reluctant, but I don't think as much of an impact on the institutional market.
Talk about geographies for a moment. We're in New York City now. New York City has seen a lot of people leave during COVID. They're in the Hamptons or wherever they are. Do you expect that people will come back, work 5 days a week, and use all the office space in New York or similar cities that they did before, or is there going to be a need for less office space?
When we think about our company, we know we're better together. Our business, we don't have the formula to Coca-Cola. We have a lot of smart, talented people who are connected by culture. And so I think being together matters. Now, yes, I think some companies will conclude they don't need quite as much space, and so that'll create some additional vacancy. People will be concerned about owning office buildings, and that may create an opportunity because there'll be some headwinds for a number of years, and then over time, things will recover.
A lot of people have moved to Florida and let's say Texas, maybe for warm weather, maybe because their states don't have income taxes. Do you think that trend will continue, and is that a good place to invest in real estate now because more people are moving there?
I would say it's a bit of both. I think the weather, the lower cost of living, lower taxes, particularly in a post-SALT world, concerns about quality of life, crime. I think the migration has, Texas is one of the fastest growing states in the country, even though it's enormous. I think that will continue, and it was accelerated a bit by the pandemic. On the other hand, New York City, San Francisco, these are amazing places. And when you think about technology and innovation, entrepreneurship, immigrants, people are going to come to these cities. My daughter's graduating from college. They want to live here. So I think there will be a rediscovery of these cities, but I think longer term, the policymakers in these cities can have a big impact. We saw it obviously in the 60s, 70s, and 80s when these cities suffered. I don't believe that's what's going to happen. And I think with the right policy, I think these cities can really thrive. But yes, Texas and Florida are well positioned.
So when you were growing up, and certainly when I was growing up, I'm older than you, people really wanted to own their own house. It was part of the American dream, own your own house. But you've been buying a lot of rental housing now. Is that because you think young adults are not as interested in buying their own home and they want to rent now?
No, I mean, there could be some of that. But if you look in the last 12 months during COVID, there's been a surge in people wanting to own homes. I think our investment, or I know our investment in rental housing, is based on the fact that we just haven't built a lot of housing since 08-09. So we've averaged less than 1 million homes built in the United States during that period, versus probably the 1.5 million we need to keep up with population and obsolescence. And so that's created support for single-family values, but also rental values. And I think now as the economy reopens here, I think the shortage in housing will become more acute. And so we continue to like it as a sector to invest in. Go where the creative and technology types are, because those are the markets where there'll be the most economic activity.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
BSO Now is your online home for weekly Boston Symphony Orchestra and Boston Pops performances. See new concerts that go behind the scenes, plus acclaimed archival concerts. Visit bso.org/now, where the music plays on. BSO season sponsor, Bank of America.
So what's the pleasure of being a real estate investor, which you've been doing for almost 30 years, as opposed to being a private equity investor or being some other type of investor? What is it that you liked about real estate that kept you in it for 30-some years?
I would say I love the people. I love learning about all these different places. I mean, I got to see all of the United States, virtually all of the developed world. You know, when you're investing in pharmaceutical businesses or other companies, it's harder to say, I have real expertise about the efficacy of this drug versus that drug. But as an individual, you could say, I've been in a neighborhood here, I'm in Oakland today, gosh, it feels a lot like Brooklyn did as it started to gentrify. I'll connect the dots and do this. So I think the tangible nature of it, the experience, if you love to travel, if you love to see places, I think real estate's hard to beat.
Right, let's suppose somebody's watching this and they say, okay, this guy has done a great job of building a great real estate business. I want to invest with him, or I want to invest in real estate. For the individual investor, what is the best way to invest in real estate?
So for the individual investor, I'd say there are a couple of ways. One is there's a public REIT market where you can invest here in the United States. There are REITs, frankly, around the world. That's one way to do it. Another way to do it today is we have things called private REITs. We at Blackstone have a vehicle called BREIT, which today owns primarily logistics and rental apartments across the southeast and southwest of the United States. And that's another way to do it. There are others who offer similar products. For some who are more adventurous, they can partner with local developers, let's say. The challenge I worry about that is just misalignment of interests and liquidity. How do you get out at some point, investing, and you're generally not getting a lot of diversity in that approach.
Well, are you worried about the economy now? The economy's been pretty good, but it probably will head down at some point. The economy is always correct. So if I say I want to invest in real estate, is now a good time, or should I wait a while before the economy corrects?
I think it's still a pretty good time for real estate, and I'd say it for a couple of reasons. One is the warning signs for real estate are twofold. Too much leverage. too much capital, and we don't really have that in the real estate system today. The other, too many cranes, too much building, and we're actually below historic levels in terms of new supply. The other thing I'd point out, if you looked at the S&P 500, it's delivered something like 4 times the return of public REITs since the beginning of 20, before COVID. So real estate is lagging coming out of the recovery because obviously people have been concerned about the physical world. I think real estate here, as the economy reopens, people go back into spaces, is going to see a little bit of a bounce. I think the risk is, do interest rates move a lot? That's a bit of a threat. I would say one positive thing about real estate also is inflation, remember, drives up the replacement cost of buildings, and that gives you a little bit of a cushion on existing real estate.
Where should I not invest my money?
You should stay away from buggy whip businesses. You should stay away from landline phone companies and some of the legacy retailers, some legacy media businesses. You want to focus on the future. And I would just say this on real estate in particular, if I had one piece of advice, where geographically, is go where the creative and technology types are, because those are the markets where there'll be the most economic activity. So the West Coast of the United States, Austin, Texas, Cambridge, Shenzhen, London, Amsterdam, Tel Aviv, Bangalore. Tech is driving so much of the growth in this global economy. Those are the most interesting places to invest.
Okay. Do people come up to you at cocktail parties? Remember what cocktail parties were when people used to get together? They ask you for any investment advice, and you always say, just invest with my firm, or what do you give people advice?
People, it's funny, they often ask me residential home prices, which is not my area of expertise. And, what I tend to tell people is focus on the longer term. Focus on, I think the danger of the world we live in, the sort of Snapchat, TikTok, meme stock thing is dangerous. And what you want to say is this fundamentally a good business? Is it in a good sector? Is this a good piece of real estate where supply is limited, demand is favorable? And if you own something good, hold it for a long period of time. So to me, find those right neighborhoods to invest in, deploy your capital, and then be patient.
John, thank you for a great overview of the real estate investment world, and I appreciate you giving us this time.
Thank you, David. It's been terrific.
Hong Kong lost its top spot as Asia's busiest airport in 2020 when passenger traffic slumped 88% from 2019. The lack of a domestic market and strict COVID rules have made for a slow recovery, and walking through the airport, the majority of F&B outlets and shops do remain closed. Here in the departure hall, long stretches still remain boarded up in areas where you would typically see throngs of passengers waiting to board their flights to destinations across the world. Only 2 lounges do remain open to travelers, one operated by the Plaza Premium Group and the other by Cathay Pacific, down from the 12 that are usually open here at the airport.
Unfortunately, when COVID had hit, we had closed a lot of our lounges and airport hospitality services. We're cautiously optimistic with the growth.
COVID certainly has forced a rethink of strategy to be nimble in the face of policy uncertainty during the pandemic era.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
Million people use Twitter every day all around the world. 20% of those are in the United States. The top of funnel is really healthy. So we get a lot of at-bats, and we just need to keep doing a better and better job of converting people to help them make Twitter part of their daily ritual.
An unparalleled career in public service. The Vietnam veteran turned anti-war activist who has dedicated his life to serving his country. Now John Kerry has a new mission, building a consensus to tackle the defining issue of our time, climate.
What I love about it is it's an issue that everybody in the world is now seized by. People realize this is existential, has the potential to be in the future for a lot of people, but it is already for a lot of people.
John Kerry is a former Democratic nominee for president, a Secretary of State under President Obama, and served alongside Joe Biden in the Senate for over 20 years. He took up the role as U.S. Special Presidential Envoy for Climate at a time he sees as pivotal.
I think that the COP26 will achieve a significant increase of ambition at the beginning of the decade, which is the critical decade.
In this episode of Leaders with Lacqua, we talk about John Kerry's climate diplomacy, the changes he's made in his own life, and what's needed for a global agreement on tackling climate issues.
We're going to break through on something. I can't tell you exactly what it's going to be, but, you know, we have the challenge of going to the moon. We invented the internet. We have a rover on Mars. We can direct it from here on planet Earth. We can get this done.
Secretary Kerry, thank you so much for joining us on Leaders with Lacqua. Now, you say that every country has to be faster in cutting emissions. Why are we not keeping up with our Paris promises?
Well, there are a lot of reasons that people aren't keeping it with a certain amount of effort. But I think not enough people are yet committed to be as serious about this moment as we need to be. Mother Nature has sent us some powerful messages over the course of the last year or two. We see all of the predictions of scientists coming true, bigger and faster in many cases. And so I think the business world is at large, for the most part, beginning to really sit down and grapple with the things that we have to do. So my hope is that some of the countries, there are 20 countries, Francine, that are the equivalent, that equal 80% of all the emissions. Those 20 countries, above all, have to step up.
So, Secretary, do you see a high risk of failure at COP26?
No, I don't, because I believe that at COP26, most countries in the world are going to step up with major raising of ambition. And I think that the COP26 will achieve a significant increase of ambition at the beginning of the decade, which is the critical decade. We have to do more, but I think that's going to be a marked jump up from where we were in the last few years post-Paris.
The president has promised to double U.S. climate finance, but it still needs congressional approval. How do you plan to achieve that?
Well, I believe that we will get that funding. I can't tell you exactly which legislative piece it'll be in or whether it'll be in the budget per se. But the answer is, I think it's a strong commitment. It's an imperative whether you're a Republican, Democrat, liberal, conservative, it doesn't matter. There are no labels on what's happening with climate crisis. And so we have to step up. $100 billion has been promised over 5 years now to less developed countries. I think it is absolutely essential that the developed world, which is, as I said, producing 80% of all the emissions, must step up in order to help less developed countries be able to respond to the crisis that the developed world has actually led the charge in creating.
But how does the U.S. actually build trust with developing nations when you're trying to persuade them to cut their emissions when they don't have a guarantee that the U.S. can do it?
Well, we can do it. We are doing it. We actually are now on a track to be able to do it. And we have a climate coordinator in the United States, Gina McCarthy, who, together with her team, has done a terrific job of coordinating efforts around our nation. Governors, Republican, Democrat alike, mayors are all committed to be moving in that direction. Many of them did incredible work in the last 4 years when President Trump pulled out of the agreement. They continued for United States efforts. So, as an example, about 75% of the new electricity that has come online in the United States is from renewables. So there is an effort going now to deploy more renewable, to shift, particularly to shift away from fossil fuel, and to begin to look at the alternatives. There's also an enormous amount of research being done. And people like Bill Gates and others are doing what's called the Breakthrough Initiative. They're looking at possibilities of new generation of smaller modular nuclear and other kinds of possibilities here. So I'm confident that when we push the curve on the technology, when we do the work of the innovation and the effort to deploy that we are capable of doing, we can get there. The next 10 years are the critical years. This decade, from 2020 to 2030, we must reduce by 50% in order to keep the 1.5 degrees alive. We are on track. We currently have a plan because President Biden created that plan. And he has put it in place for the most part. You heard him announce with Ford Motor Company and General Motors and others that by 2030, 50% of the automobiles sold in the United States will be electric. The president has set a goal that by 2035, our power sector will be carbon-free. No oil, gas, or coal. So those are strong goals. And they are achievable, and I believe President Biden is putting the country on a course to able to achieve them.
Secretary, to the cynics that say that actually COP26 is just another high-level meeting where there's a lot of talk but no substance or no action, or to the climate activists that also question what our leaders are really doing, what do you tell them?
Well, it's the Glasgow meeting is not just talk. We have been engaged at President Biden's direction in major international diplomacy over the course of the last 9 months. We are working with basically all countries, but principally with those 20 countries that I talked about that are responsible for 80% of all the emissions. And the fact is that most of those countries are announcing new reduction levels, and they are announcing them because of the meeting in Glasgow. They are submitting those new plans to the United Nations. In many cases, those new plans are significant reductions, particularly with the 55% of global GDP that I mentioned to you is committed to the 1.5 degree limit track. So the fact is that Europe has committed to a reduction of 55% over the course of the next 10 years. The UK, 78%. The United States, 50 to 52%. Canada, 46% to 50%. Japan, 45% to 50%. So the scientists tell us we have to cut by 45% over the course of the next 10 years. That's exactly what the 55% have committed to do. Now we have to get other nations to step up. We're working with Russia. We're working with South Africa, with Mexico, with Brazil, with Saudi Arabia, with a whole group, India, a whole group of countries, and they are right now sharpening their pencils and working to shape the announcements that they're prepared to make in Glasgow. So Glasgow will be a raising of global ambition. It will not guarantee that we are absolutely, as a planet, all on track, but you will have many, many countries raising their effort to very significant levels, and I think there will be much more that comes in the months and in the year or so after that.
Up next, diplomatic tensions collide with the race to net zero. John Kerry's views on the challenges and opportunities of U.S.-China cooperation on climate.
We're not trading off anything in other issues. What we're doing is trying to make, I'm certainly focused exclusively on the climate track and trying to see how much progress we can make there.
Talk about hiring aggressively at the moment. Can you walk me through how challenging that is at the moment? How difficult is it to find the right people?
Well, things have changed. Again, the world has changed under the pandemic, and you all know worldwide, what the challenges with getting people back into the workforce.
How much stress is there at the moment amongst the asset managers that actually some of the ESG labeled products, then if you probe, are not green?
Well, look, there is some stress, and it's great that there's that scrutiny, and there's that skepticism or healthy skepticism about ESG labels or sustainable labels. And that, again, is one of the reasons we're having this ruthless, relentless focus on net zero, because in the end, look, we can't stabilize the climate unless we get to net zero. And it's as simple, these are hard numbers. Your emissions are either A or B, they're going up or down, and if they're going down, are they going down consistent with the science? We anchor it in the science, the same science the UN and others use for the 1.5 degree objectives.
Should this not be compulsory? Should we not have regulators coming in and saying, look, this is a new definition, you stick by it, and we're going to measure it?
So I think it's a great question. So let's look at what happened with TCFD, climate disclosure. 6 years ago, you and I were in Paris, we talked about this, we talked about other things. Now that's moving to become mandatory.
John Kerry is a veteran diplomat, a former U.S. Senator and Secretary of State. And his diplomatic skills are getting put to use in his new role as U.S. Special Presidential Envoy for Climate, particularly when it comes to relations between the United States and China. Secretary, what about China? So the country said it will stop financing coal plants abroad, but not at home. Should the U.S. and actually, China not make a pledge to phase out these coal-fired plants at home?
Well, we've expressed concern, obviously, to China about the level of coal. That's not a secret. We've been working with the Chinese. President Xi is very focused on this issue. He's personally involved in decision making, and I'm confident in the next weeks we're going to be getting together with China. We hope we can find more common ground for moving the process forward. And we're looking at a number of different ways in which we might be able to do that. So I remain hopeful that we can still get something done before we go to Glasgow, and I'm hopeful that China will on its own. That President Xi will make the decision that they could move further with respect to the reduction of emissions during the course of the next 10 years.
Is climate cooperation with China actually tied to U.S. diplomatic relations with China?
Well, I mean, everything we're doing with China is a consequence of diplomacy, and obviously those conversations are taking place. President Biden and President Xi both agreed in their first conversation that they wanted to try to make progress on climate and that it shouldn't be held hostage to other issues. We're not trading off anything in other issues what we're doing is trying to make, I'm certainly focused exclusively on the climate track and trying to see how much progress we can make there. Needless to say, in the last few months, those efforts have been somewhat entangled by some of the other things. My hope is in the next 4 weeks we can make some more progress.
Why is it so difficult to have a clear definition of net zero? And how much would that actually help businesses to track and to do better and governments to do the same?
I think there will be a clear definition of net zero by the end of the COP, the end of the meeting in Glasgow. I'm confident that people are working on that. They're also working on something called the rule book. It's pretty archaic. It's technical language for how one measures what people are doing and what the transparency rules will be and so forth. That, we hope, will be one of the outcomes of the meeting in Glasgow. So I think we're on a constructive track to make progress there.
We talk a lot about greenwashing, especially amongst businesses or certainly in the financial community, Secretary. Are carbon credits and offsets a meaningful way to deal with climate change?
They're a necessary problematic way to do it. We need offsets to be able to do some of the things we need to do quickly, but you can't have them going on and on forever, or you simply don't wind up with the reductions that you need. So that is one of the issues that will be the subject of discussion and is already the subject of discussion in the working on that instrument I just mentioned called the rule book. And hopefully out of Glasgow there will come unanimity with respect to how people are approaching that. But what we need are real reductions more than we need. I mean, offsets are necessary to get some companies over the hump and get them started, but we can't rely on them in the long run because otherwise you don't get the reductions that you need.
What are some of the conversations you're having with financial companies? So there seems to be a time problem, or at least a timeline problem, because the finance industry may not be able to actually reallocate capital and time to avoid some of those, dangerous temperature gains. So what do you do?
Actually, the world of finance has been stepping up in these last months. The 6 largest banks in America have announced how much they will invest over the next 10 years in climate activity, climate-related initiatives. And the amount of money they have laid out, the 6 of them, is $4.16 trillion over 10 years. That is money for commercial ventures and operations, but energy is a sector that should lend itself to commercial solution. I mean, if you have the ability to deploy renewable energy, for instance, solar or let's say wind, and those projects are let at a level where there is a sufficient revenue stream, there's no reason why that isn't a long-term investment in commercial sector. It's a straightforward deal. And you can get a purchase power agreement that lasts for 20, 25, 30 years, which gives you a return on that revenue. And that's how you can wind up deploying very, very rapidly. We're working with India right now. India has made a commitment to deploy 450 gigawatts of renewable energy. But India will need finance and technology to help move that as fast as it needs to go. We've created a partnership with India. We're going to work with India closely, and hopefully those the power purchase agreements can be put together in a way that allows those projects to go forward. And we're doing that on a global basis. We're working with Indonesia. We're working with South Africa. We're going to work with other countries in order to try to help bring the finance to technology to the table so they can make the transition. And that's one of the reasons why the $100 billion is so critical, because that was promised to developing countries in order to help them be able to get over the hurdle of the transition, which they cannot afford to do on their own.
Up next, John Kerry is at the center of global climate diplomacy, and it's had an effect on his habits and his lifestyle. We'll discuss who Secretary Kerry admires and what the job means to him.
What I love about it is it's an issue that everybody in the world is now seized by. People realize this is existential, has the potential to be in the future for a lot of people, but it is already for a lot of people.
market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
John Kerry has one of the most high-profile jobs on the world stage as U.S. Special Presidential Envoy for Climate, meeting with world leaders to try to secure commitments to decarbonize. I asked who Secretary Kerry admires and what this pivotal new role means to him on a personal level. Secretary, what do you like most about your job, and what do you find most frustrating?
I find frustrating that we don't have the money in the budget at this point in time, and we're not just putting it out there on a rapid basis to get the speed that we need for this transition. We've got to work around the edges to make that happen. What I love about it is it's an issue that everybody in the world is now seized by. People realize this is existential, has the potential to be in the future for a lot of people, but it is already for a lot of people. And so you have people all around the world, some of whom have to move because they can't live where they're living anymore. The heat is getting intolerable. The drought is too long. The production of food is interrupted. Their water supplies are diminished. And we in the United States have the ability to be able to do something about it and make a difference in their lives and indeed in the future for all of us. That's a pretty big privilege to be able to help work on. And I have a superb team, all of whom are focused on Glasgow as the jumping off spot to really try to create a framework through which we can make good things happen. And that's what we're trying to do.
How confident are you that it's the new technologies, and actually technologies that also get cheaper, that will really lead to a radical transformation?
I'm confident about it because that's something that we in the United States and some other countries do extremely well. We had to do vaccines, we did vaccines. We had to deal with AIDS, we dealt with AIDS and came up with a program for various parts of the world and made a difference. We needed to stop Ebola. Under President Obama, we stopped Ebola in West Africa. Millions of people were predicted they were going to die. 11,000. That's too many, but we lost only 11,000 compared to the millions. We can do these things. We've cured diseases. I mean, we deal with smallpox. We deal with polio. We are making progress in so many different ways that never gets reported on adequately because it's the crisis that obviously commands attention. But the fact is that when I was in college, the severe poverty rate was over 50%. Today, for the first time ever in history, it's below 10% in the world. If you're a woman in the world today and you're pregnant, you're 50% more likely to give birth to your child and that your child will be fed. I mean, there's just an enormous amount that we are capable of doing if we put our minds to it. We are now researching and developing in carbon capture and storage, in battery storage, in green hydrogen, in direct air carbon capture. We're going to break through on something. I can't tell you exactly what it's going to be, but, we had the challenge of going to the moon. We invented the internet. We have a rover on Mars. We can direct it from here on planet Earth. We can get this done.
Is there someone you admire in the space for clarity of mind or, drive, fire in the belly to get this done in the sustainable space?
Well, there are many people, and it begins with, Jim Hansen, who testified to us when we were in the United States Senate in 1988 and told us climate crisis is here, it's happening. And then there are just so many people who've been on the front lines of this fight for so long, including now, most importantly, young people, kids in schools who are willing to, strike and willing to step out and lead the efforts of accountability. And they're asking the adults to be adults. Pretty simple request. Do the things that we know we have to do, be responsible as leaders in public places, and get the job done. It seems to me that's by far not too much to ask.
Yeah. Given the fires, given the tornadoes, given the floods, given the UN reports, how many climate change deniers do you still meet?
I'm not counting the deniers now. We're beyond that. The evidence is clear. People are accepting the science in a large majority in the United States and around the world. We are the only country, by the way, where we have people called deniers in that level, and who are denied for as long as they have the consequences of climate. But even now, many of them are changing because they've seen what's happening in their homes, in their states, the floods, the fires, the mudslides, the air quality. It's pretty hard to miss it now. So I don't think the challenge now is deniers. I think the challenge is getting both parties, because climate has no affiliation with any party or ideology. Get everybody together, listen to the scientists. This is not a matter of ideology, it's not a matter of politics, it's about arithmetic and physics. And the scientists are doing what they're doing based on that arithmetic and physics, and they're telling us what we need to do as public people, as policymakers. That's the challenge.
Secretary, have you changed anything in your lifestyle to actually help the cause against climate change?
Indeed, I have. I have a solar system for my home. I drive an electric car now. I still have the one internal combustion engine vehicle, which is being traded for another electric car, and we're making more conscious decisions about our use of energy within a house. I've become a flagrant light switch, a chaser. Whenever I walk through a room or a building, yes, I think there's a new consciousness. Am I doing everything that I should be or could be? Probably not. But I'm super conscious of the need to try to, all of us, do what we can to make a contribution here. The biggest thing I'm doing in my lifestyle is traveling around the world, trying to do diplomacy and help make a larger decision in the context of Glasgow that could reduce a lot of the anxiety that we're all living with today about where we're headed.
Secretary Kerry, thank you so much for your time today.
My pleasure. Thanks for having me.
It's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
China is a gigantic part of our economic life and will be for a long time, for our lifetimes. But that does not mean that we should be naive in the way that we look at our our critical national infrastructure, the way we look at, you mentioned nuclear power, you mentioned 5G technology. Those are all legitimate concerns that any government, many other governments around the world have. But I want to be, I've said this many times, it's worth repeating, I am no Sinophobe, very far from it. I think.
Do you think you're the last Sinophile in the cabinet?
No, I expect there are lots of. Look, China is a great country and civilization.
What about wind power? Would you let them buy offshore wind power? That's infrastructure.
I think you'd have to
railways.
You'd have to look at what was you're defining as strategic or critical.
Supply chain team's done a great job on semiconductors. We've been able to secure semiconductors for our entire business globally and been able to keep all of our installations globally, which we do almost 10,000 every day, somewhere in the world, all on track.
All right, so here we are in front of the elephants.
Since this very first YouTube video was uploaded 16 years ago, the world's most popular video network has exploded to more than 2 billion users in the farthest corners of the planet, now raking in billions of dollars every year. It's evolved a long way from cat videos to become a one-click journey to the center of the zeitgeist, pop culture, and kid culture, amplifying some of the brightest and sometimes darkest traits in all of us. While YouTube has elevated a generation of creators and educated and entertained generations of viewers, it's fought misinformation, terrorism, racism, and violence many clicks along the way. Lately, YouTube's biggest battles are focused on eliminating COVID and vaccine misinformation and keeping the platform safe for kids and teens. On this edition of Bloomberg Studio 1.0, we rewind to talk about where YouTube has been and fast forward to where it's going next with one of the longest tenured employees and women at Google, the CEO of YouTube, Susan Wojcicki.
It's been 5 years since we last talked on camera. Yes. And we have a new president. We are weathering a pandemic. The most watched video on YouTube is
Baby Shark.
Baby Shark. So a lot's changed since 2016. How do you feel about YouTube 2021 versus 2016?
I feel good about it. It's definitely been a while, and in technology things move so quickly, so a lot of things have changed since 2016.